COVID-19 began as a medical emergency, but it didn't stop there. The pandemic has led to the greatest global economic crisis since the Great Depression. And this crisis is magnifying inequality. Early estimates suggest that women are nearly twice as likely to lose their jobs as men. And low-income women are the most at risk, especially those in low-income countries. Think of the garment worker whose factory has shut down because global demand for new clothes has stalled. Or the woman who sells food in an outdoor market and has had to close down her shop because no one is gathering there anymore. Yet local banks don't usually give loans to women, so they often have to turn to friends and family for money if they want to start a business. They usually work 2 jobs, one that pays them and one that doesn't: cooking, cleaning, and caring for their families. Many of these women have struggled for years to put their lives and their families on solid economic ground. But then a virus started spreading around the world, and now those years of hard work and sacrifice are being completely erased. And this is where leaders can and must step in. This year, more than 1 billion people worldwide will receive money from their governments to meet their basic needs amid COVID-19's economic fallout. And these emergency cash transfers are a good way to prevent this pandemic from locking women into poverty. But here's the challenge. Too often, the cash doesn't end up in the women's pockets, all because they are not identified as the head of the household. But we can reach these women, and I want to introduce you to someone who is helping reach them in India.
I think it's time that the world moved from the concept of household income to individual income, and I think that's where the Indian government has done a brilliant job. Where money was directly credited into women's bank accounts, women tend to be more prudent spenders, and they're also cautious with the money. So overall, I think the combination of the money getting transferred into their accounts provided them with a sense of financial independence and a transfer of social power.
When policymakers think about who they're designing cash transfer programs for, I hope they remember the women it helps. I also hope they keep this in mind. These cash transfers don't only help the women who receive them, the benefit is much bigger than that. That's because when women have money, they tend to spend it on their children and communities. So increasing a woman's economic power creates a virtuous cycle. When a woman has money, she puts money into the pockets of more women, and the cycle repeats itself. If we empower women economically right now with measures like cash transfers, addressing unpaid care, and other policies, then we could create as many as 230 million new jobs. And every single one of those workers would be getting paychecks, all because of our investment in women. So as the world confronts a long-term global economic recovery, one solution must be at the center: making sure women have economic power, that they have money.
Very warm good afternoon to all of you once again. I would like to thank each one of you for joining us for this afternoon session, plenary session titled Small Finance Banks Delivering on Financial Inclusion Agenda. It's my pleasure to invite the esteemed panel for the session. The session will be moderated by Bindu Anand, Chair, Dwara Trust, and the panelists include Rajiv Yadav, Managing Director and CEO, Fincare Small Finance Bank, Sanjay Agarwal, Managing Director and CEO, AU Small Finance Bank, and Paul Thomas, Managing Director and CEO, ESAP Small Finance Bank. We request the participants to share their question in the Q&A box and respond to poll questions as well. With this, without further ado, I would I will hand over the charge of the session to Bindu. Bindu, over to you.
Hello, everyone, and welcome to this session on small finance banks. I'm Bindu Anand, and I'm delighted to be in conversation with CEOs of 3 of our leading banks in India, Rajiv, Sanjay, and Paul. We want to keep the conversation, as Arya mentioned, very much interactive. So we will definitely have time for Q&A. And in addition, I'm told that we will also have a few polling questions. So do look out for that. So let me dive in with that. The last 5 years have been a turbulent time for the Indian banking sector. In that landscape, I think SFBs stand tall, having successfully made the transition from NBFCs to banks, delivering superior ROAs and ROEs compared to other commercial banks in the last 2 years, and really building out what we all thought would be the hardest part of it all, which is the successful franchise in liabilities. Today, we have a wonderful opportunity, thanks to this summit, to go behind the scenes with these CEOs and understand really the blood and tears behind this journey. And additionally, I also want to explore from a policy perspective, is there indeed a differentiated business model emerging, as was the expectation for SFBs? Or is it, on the contrary, evolving along the same lines as private sector banks? So that is sort of the second part of what we will explore. I want to start really by asking, because it's so rare to get a chance to directly hear from the leadership, but I want to start by asking each of our panelists to reflect on the journey so far, roughly the last 5 years, and share with us in 5 minutes or less some key moments, milestones that really stand out for them as they think about it. Paul, if I can start with you, please.
Thank you, Bindu, and thanks to Access for hosting this panel in this year's Financial Inclusion Summit. And even during this pandemic, they were able to organize this summit on a virtual mode. So that itself needs a lot of applause. So as all of us know that the COVID-19 pandemic has really taken us the entire globe on a backseat now. So over the last 25 years, a recent World Bank study reveals that the progress on the poverty as the growth phase has slowed down significantly. So, and they're projecting around 88 million more people will be added to the the group, poverty poor group. So in this context, actually, the banks like us have a more relevance. I feel that small finance banks, that these experiences has got more relevance. And if I look back last 5 years, yes, definitely. The first moment was the 2015 September when the announcement came. That was a joyous moment for all of us. We were in the list of selected 10 banks. That was first. Then the second was mainly the launch date, launching a bank in a very limited time. So we launched the bank in 2017, March 10th, we launched the bank. So that was two significant events. So then the whole the transition process from an MFI to setting up a fully regulated, highly regulated bank was it was a really challenging journey last 5 years, but it was at the same time very satisfying for me and the entire ISAB team. It was really a satisfying moment for us. And in 2018 December, we got the scheduled status. We became a scheduled small finance bank in 2018, and the first 100 branches converting the old microfinance branches to full-fledged regular branches, and achieving that first 100 branches was a great milestone for us. Then we got the membership in the Global Alliance on Banking on Values. We are the first bank from India to become member of the Global Alliance on Banking on Values. So, and one thing that last 3 years after we launched the bank, so we couldn't dilute any of our mission. So we continue to focus on our mission. And another great milestone was that on the launch day itself, we were able to open bank account for all our existing customers, microfinance customers. Yes, it was. If you ask me whether it was a prudent decision on a financial terms, it was not. But on a social banker, it gives me a lot of satisfaction. We were able to give them say, a bank account and a debit card. And another challenge, most of the MFI migrated SFBs were facing that how do we manage the liability because we have to all the migrated grandfathered liabilities were there. How do we pay out? How do we mobilize? We are new, but that also by completing first year we got the confidence that we can. We continue to give a differentiated service, differentiated rates we offered, and our doorstep banking service, our experience in the MFI as a doorstep service provider really helped us to we continue to give a doorstep banking. So today we have 8,200 crore liability book. So and last 3 years, I never, last 25 years before launching the bank, every year, the major concern was the liquidity. Every time it was a pressure on liquidity. And so now that problem was solved. We have access to public deposits. A lot of many other options were also opened up. And also, if we could double around 200% of growth in the customer base and even on the asset book has grown around 40%, from 1,900 crore to 7,200, 7,400 crore today. So over the 5 years, that was a great achievement without facing much challenges on. And we get, I said, we continue to bank with our customers. And as our tagline says, joy of banking for everyone. So we made air-conditioned premises for even including our micro-banking customers. And in 3 years, all the another major achievements, if you ask me, I could convert all the regular commercial bankers to a social banker or a differentiated banker. Many of my colleagues joined from many private commercial banks were convinced about the model of banking with the focus on social transformation and economic transformation and on the they could see it and they could experience it. So that was some of these last 5 years journey I conceived.
Thank you so much, Paul. And we will come back and I think probe more particularly around the liability success story. Rajiv, if I can come to you next, some quick reflections on the 5-year.
Yes, thank you, Bindu. Thank you to the Access team for organizing this digitally. It's so good that we can still have this in current times. I would say, firstly, very strong, similar overlap the way Paul described the journey. Most of the SFBs have had those key milestones, getting the in-principle license, working through the whole conversion process, converting to final license, and then launching it. A big element at the time of launch and after the launch is obviously technology. So, and obviously hitting various milestones like schedule status, conversion of our branches, getting our deposits to be nearly equal to our credit. So therefore getting to a very good deposit ratios, creating liquidity for the bank, when your liquidity is starved. So, when the digital side of it, you keep on adding some great things and, bringing out things which at least today a lot of customers are used to, and a bank which is new does not have all those features on day one. Sort of concept level, very similar to what Paul described. I'll just talk of, Bindu used the word blood and tears in building the bank. It's been now nearly 5.5 years since we all got the in-principle license. And I would echo what Paul said. It's been a very tough journey. It's a very hard-working journey, in terms of the amount of work that goes behind to get this thing to work and accelerate things. We are all running existing organizations. There were assets, so you have to build liabilities. The expectations are very high. The market is looking at you, even if you're unlisted, the market is looking at you and saying, is this model going to be successful? The regulator is looking at you and saying, hey, is it a good thing that I've done? Is it a not so good thing that has happened? So I think the way it was set up, I think our own expectations of what we think we are capable of doing and what we have done in the past doesn't matter, but the future matters. So I think it's an extremely high hard work. As I said, very high expectations. The third thing I would say, it's a very intellectual phase because there are no ready answers for a small finance bank. The big commercial banks are operating in very different markets and very different segments. So you can look for some answers on compliances, some answers, on a few bank processes from them. But when it comes to products, customers, a lot of the answers have to be very customized. What works for a big bank doesn't work for a small finance bank. So, when we sort of, even today, it's all about what is the gap between a larger vision and how do we cover that gap and what are the right decisions we take to cover that gap is a very big key part of the intellectual thinking. So overall, and we'll answer some of those questions. I think the asset strategy, the liability strategy, the tech strategy, the people strategy, I think 4 big building blocks which had to be addressed. And we are far better off at the 3rd year point, 4th year point that we are all at. But the journey is a little longer and there's a lot of work still to be done. But great outcomes. So pleased that all the 10 SFBs have done well. The format of the bank is very strong. It serves a significant objective of what we had, as a converting entity, and I think what the regulator has, what the government has, what the customers have, and because it's a great format, I think all 10 SFBs have proven good success out of this conversion.
Thank you so much, Rajiv. Sanjay, over to you. Any surprises in the last 5-year journey? You're on mute, Sanjay.
This is...
Yes.
Yes. So yeah, so I'm not a techie guy, right? So Bindu, thank you so much. Access, thank you so much. In the interest of time, I would echo what Paul Saab and Rajiv just told about the whole narrative around SFB. And our journey remained a little bit different from most of the SFBs because we were more into the other product than a microfinance. So entire piece of getting licensed, the conversion, the technology, the people, remain same. But, being in NBFC with a lot of assets around wheel, SBL, home loan, and but I would say bank has actually surprised us as a platform, actually surprised us with this width, length, and deepness. What we were doing as NBFC, now when I go back and visualize my last 20 years and last 5 years in comparison, then I feel that I was doing nothing as NBFC, honestly, because the kind of hard work, the kind of overall leadership traits you require to handle a bank platform is immense, and we've not been, studied like this or not been coached like this. I'm a first generation entrepreneur, right? So the environment is teaching us every day, whether it's an environment of regulator, the environment of the government, the society, the customer, the employee, the technology, every day there is a new challenge. But I'm very happy to, say after, this is close to now 15th quarter of our journey as a bank, what we have achieved as in close to 2 million customers, now we are around 20,000 employees with around 800 touch points, and we are growing by 30-35% in all respect, whether it is asset or liability. We are actually putting a lot of effort on digital, which one initiative or one thing which separates you from NBFC to bank is only technology, honestly, because of course deposit franchise you can't do there, but the CEOs has to understand technology. If you don't understand technology, you will be far behind. So the whole payment structure, the whole engagement initiatives, the customer interaction, the customer reach, it's all is happening through digital. So we are very happy the way we have built ourselves in last 4 years, because we were zero as an NBFC on a technology front. And now we are having a 24/7 kind of call centers, the engagement, the internet banking, mobile banking. We're about to launch credit card. So very happy to see and actually explore myself as an individual on this platform. And I'm very thankful to RBI to give us this opportunity, honestly, because in life you won't get this kind of opportunity to run a bank. And milestones always, my one milestone might be different from others, because we got listed in 2017 itself, and now is close to 3 years. So I have one more added pressure, which is quarter to quarter, is to reply to the investors. So other than that, Bindu, enjoying this ride, enjoying this roller coaster ride. Honestly, I won't say this is a very plain ride. So you don't know when you go down and when you go up. So, but enjoying every moment of it.
Thank you so much, Sanjay. And certainly sounds like it's been an eventful 5 years and exhausting for all of you. But lovely to hear the perspectives. For the remainder of this conversation, I want to explore in depth really 3 dimensions of SFB performance that I think as a group we all care about. The first is outreach and cost to serve. Second is building the liabilities franchise. And the third is diversification of the loan book. And what I will do is I will share some data points just to set context, motivate the discussion. And then I'll ask each of our panelists to help us understand the story behind the numbers in the context of their own organizations, but also the SFB industry in general. So for that, I'm going to now try and share my screen. I hope this is visible to everybody. Let me put this on full screen. So it's a little bit of a crowded graph. Let me take a minute. So this is what you see is a picture of outreach, i.e. spread of the branch network as of January 2021. Each of the bars represents a category of bank types. So the first one, SBI and its associates, get a bar of their own, of course. The second is nationalized banks, so on and so forth. Arya, were you trying to say something? Okay, I'm going to keep going. And on the rightmost side, and hopefully this is visible to you, are the newest kids on the block, small finance banks and payment banks. And I thought it'd be helpful to look at this in a single graph so that we see where do the new entrants vary, where do they actually mirror incumbents. So if you look at the gray bars, which is the proportion of branches in rural areas, and each of the color coding represents a market. So gray is rural, orange is semi-urban, brown is urban, and green is metros. So if you look at the gray bars, which is rural, no surprise there that that is dominated by SBI and public sector banks. For SFBs, as of Jan 21, about little less than 20% of the branches are in rural areas. And surprisingly, payment banks, that number is only 5%. If this were a panel on payment banks, we would dive into that in a lot more detail. But the other thing that I want to point out, and then invite Rajiv to come in and talk about the branch kind of story, is that if you look at the small finance bank bar and the one right next to it on the left-hand side, which is the private sector banks, that actually looks pretty similar. That was one of the things that jumped out at me when I looked at this bar. So Rajiv, if you can maybe start with that, is that by design, or do you have really a different branching strategy in mind? Over to you, Rajiv.
Bindu, I'm not surprised it looks quite similar, except for the few differences which are also very obvious. But let me try and explain the similarity, and then I can explain the differences. So, at the rural level, the numbers are quite similar because we all broadly, firstly, we are trying to achieve our rural banking target of 25%. There are other kind of formats also which can achieve it. So therefore, it's not exactly 25, but private sector banks, small finance banks by nature are, and these are unbanked rural centers. A lot of them are unbanked rural centers, and therefore they're somewhat similar. A bank like ourselves, and I have a feeling that similar to others also, we service rural customers, but we don't necessarily put up rural branches. We are a 95% rural bank on our loan side. And we are really happy and proud of the fact that we are a rural bank. But it doesn't necessarily mean that we have to put a physical infrastructure in the tier 5 and tier 6 towns. So sometimes people miss the fact that lack of rural branches doesn't mean that small finance banks are not rural banks in terms of the customer base, especially the microfinance-led banks. So therefore, most of our infrastructure will lie in tier 1, tier 2, tier 3 towns. Our branches will lie in those towns, whereas the rural is defined as tier 5 and tier 6. Some of those the branches are out there being used for meeting our necessary requirement on the unbanked rural centers. So therefore, that number matches, which is somewhat similar to what the big private sector banks are doing. As you see, the other critical difference is actually the big difference is the other side, which is the metropolitan branches. The bigger banks, by their 20 years, 25 years of existence, and I'm talking about the private sector bigger banks, and the fact that they are super strong and super focused on their retail franchise in the bigger cities. So they have a very deep branch network to cater to the customers in the big cities. And all of us small finance banks, one, do not have a business model to start with on the significant business model in the pure metros, and two, to sort of compete with the big universal banks head on and put up a similar number of branches is not something which is economically viable in the short term or a wise strategy. So therefore, all that we have done is we put necessary infrastructure out there to bring the brand, to bring the reach, and to service the customer a certain way. But we're not competing with the big private sector banks in terms of distribution reach, in terms of branch network. So you will see a wide difference. They will have a significantly larger proportion in the metropolitan areas, and small finance banks will be relatively far smaller. The big focus of the small finance banks is in the semi-urban areas. And as you can see, that is a larger block. It just matches with our customer segment. It matches with what we are doing in the earlier past. So clearly, it is targeted to the way all of us were doing business, where we see a huge future growth potential. And it mirrors private sector banks in a somewhat manner. But there's a big difference between the metro focus and the rest of the segment and the semi-urban focus.
That's really interesting. Thanks, Rajiv, for interpreting. And this point around, many of your customers are rural, but the branch network does not necessarily reflect that. Mr. Thomas, if I can turn to you and ask you about your thoughts on the channel strategy, but also if you can speak about how important are business correspondents, what are the non-branch strategies that have worked well for you?
Yeah. Overall, on the branch strategy, I agree with what Rajiv said. So even though, because we were all, when we were in MFI, we have opened our branches close to another bank branch, because we have to bank, we need to have the banking service access. So that is why most of our, when we convert, those branches are still in urban areas. But overall, if you take in our case in ISAB, we have a 77% of our branches are in semi-urban areas. And with a specific focus on unbanked rural, 25% is mandatory, but we always maintain around 30% plus branches are in unbanked. And many places, even in Kerala, we initially thought that there will not be any village available to open a branch, but we could see if you go to interior Munnar and all, you could see small branches of ISAB bank there. But from the day one, we also have adopted a strategy for a business correspondent strategy also. So entire microfinance or micro banking services sourcing and servicing, from day one, we did through our business correspondents. So today we have around 13 business correspondents spread across different states. And apart from our 520 banking outlet, there are 196 customer service centers fully managed by the business correspondents. So we wanted to use that channel, and from day one, the launch date onwards, we have adopted that channel. I think now all the other small finance bank also now appointing that BCs and adopting that channel. So going forward, we see that channel will grow because because setting up a bank branch needs the cost is very high. So that 40 if an urban branch costs us 40-45 lakhs to the initial setup cost. So to make it break even viable takes time. So instead of that, so you can start with a partner. So we are going with a partner. They already have a customer base. So we can start a business. Then later, if there is a possibility, potential, we can open branches. And many of you, if you see the graph also, almost similar to the private sector banks, or metro branches are also, because in India, the larger deposits, the liabilities lies in the urban areas, cities, metro cities. So we have to focus on the metro branches. But again, metro pure liability, we have to still evolving asset products suitable for the metros. So going forward on the channel perspective, I am foreseeing BC as a channel will grow, and the digital, standalone digital channel, because till the COVID, we believe that our set of customers, the majority of our micro banking customers, they always need a assisted digital. So from day one, we had a tab banking model. It's an assisted digital model. But the COVID pandemic proved that 30% of our customers started using their customer initiated digital also. And when we do a demographic study among our customers, around 30% of our 50% of our customers comes under the 20 to 40 age group. So that also they are more tech savvy. So that digital is possible. So digital, even including financial inclusion and the micro banking segment, digital as a channel will grow. So we are also started investing on building up our own digital channel. So,
Paul, if I can ask you roughly what percentage of your overall transactions are digital, roughly?
As of now, it is only the disbursements are completely on through 100% bank through bank accounts, but repayments still on around 90% still on cash. Because the rest only around 10% they use bank transfers for making the repayments. So we need to, if we effectively wanted to bring these customers, the target, the micro banking customers to digitize their cash, their income has to be brought to the banking system. Then only
the source needs to be digitized. Absolutely. Thank you so much, Paul. Sanjay, turning to you, your thoughts on channel strategy. Also specifically wanted to hear from you on OPEX and cost to serve from your NBFC avatar to bank avatar. How much has it changed and which of it is a channel related story?
Yeah, Bindu. So, before talking to, speaking around our branch strategy, we all need to understand the whole design principle around SFBs, right? Because SFBs are supposed to do 50% loan lesser than 25 lakh. Our priority sector requirement is 75. Our branch has to be, unbanked branches around 25%, but we all do around 30%, right? And we all need to raise deposit to do all kind of financial inclusion, because Bindu, I personally believe that you have to do first loans to do financial inclusion, right? You can't expect people to deposit money in the rural or maybe more hinterlands of the country, because they don't have money, right? They have to generate money, correct? So, and in all my passing remarks, I always say that SFBs are Robin Hood model, right? So we need to take money from HNIs because they only have the money and have to distribute into the people who really underprivileged or people who are into the ruler and all those stuff. So our strategy are two things, right? Because as NBFC, we remain into this lending model, and we were into this semi-urban and rural areas. So that is the old franchise of AU. But as you know that we need money, so we always we keep focusing on the metropolitan or the urban centers. And I believe that every SLB, they have to time themselves, but they have to come in urban to raise deposits, right? Because there only people will start believing that you are actually a bank, right? So we remain around 30% our branches are into urban centers or a metropolitan, 70% remain into core markets, which we say about semi-urban and rural. But if this 30% urban and metropolitan branches give us 70% deposit, right? The core market only gives you 30% of deposits, right? And in terms of our asset, it's 50%, right? So we have to keep investing in our branch outlay, whether it's physical, virtual. And as Paul always mentioned that BC can be a new area, but it's not easy. It's not easy to govern BCs. They have their own challenges. But I have strong feeling around the digital distribution, and by allowing video banking now, so. In urban centers, SFB can become more effective if they use more video banking, because then you don't need a large branch setup with large capital outlay. You rather can put a video banking in Mumbai or maybe Delhi, maybe Bangalore, maybe Calcutta, where you can have 2-3 setups and do all kind of engagement, acquisition, service, with the customer through video banking. So digital can be a big change in our strategy as we move forward in terms of our distribution. Other than that, I strongly believe that next 10 years it will go hand in hand, right? Because it can't replace, one model can't replace the other model. So for next 10 years, I believe that we as an AU will keep on investing on our urban centers. We'll keep on working on our rural centers, because that's our core for our working. And we'll also build through digital, right? In terms of cost, Bindu, because as I already told you that the cost on NBFC was very less, because we neither have invested in our branches, neither on technology, neither on people. It was more of a rough kind of model where, we would be sitting at 4th floor, back room, without technology, without connection, all those stuff. But you as a bank has to play some character, right? You have to build some kind of image around you. Otherwise, people won't trust. And if people don't trust, you won't get money, right? If you don't get money, how you lend it, right? Sure. So you need to keep investing in our branches, your outlook of your people, branch.
Sanjay, is there a data point you can share with us? Completely understand that NBFC Avatar was different.
Yes, sure. So cost to income, before a bank was around 30-35% cost to income, right? Now is around 55%. And I don't think that it will going down very sooner, because you have to keep investing in the every 3 aspects, which is people, technology, and branches.
Sure.
And cost to service, which is also high, because you have to pay people more. You have to use technology. There is an attrition. There is a competition. We are not very stabilized as a franchise where people will stay for long, right? So the cost is high, but I think because we have an added advantage, because our lending rates is also high. So we can actually protect our name. So I'm not too worried about cost, because you can play on our lending rates, you can play on your cost of funds, and build your around somewhere, right? But yes, ROA has dipped from NBFC, we were in 20% plus ROE. Now we are close to 15%. But that's good enough, because for sustainability, right? I strongly believe banking franchise is more sustainable than an NBFC franchise.
Sure. No, thank you so much for that, Sanjay. That's very helpful. And we've been talking a lot about liabilities, so I want to sort of go into that next. Hold on a second. And it's really, to the point that Sanjay was making and what he calls the Robin Hood strategy. That's an interesting way to talk about it. That there is sort of, one leg in rural and one leg in urban based on the product. So want to explore the liabilities question a little bit better here. So here's some data on the spread of deposits. I hope you all can see this. On the left-hand panel is the number of deposit accounts, and on the right-hand side is the value metric, the amount outstanding in deposit accounts. And so, this is all SFB, and this is March 2018 and 20 comparison. So if you just focus on March 2020, so Metro's account to the story that you all have been saying for more than 50% of deposits, and metros plus core urban centers together is, 80% of the story. So this clearly speaks to this sort of, I'm going to target this market for liabilities, whereas my core kind of lending group continues to be what I was doing earlier. So I want to go around again and sort of get a sense of, do you see this continuing into the future, particularly given the rising competitive intensity for metro deposits? More universal banks are going to get licensed, more pure digital players are going to come into the market. How do you see this liabilities sort of story evolving over time? And do you think, for example, semi-urban, which is currently 16% by value, 40% by number, is that going to be a bigger part of your story? Paul, if we can start with you.
Yeah. Yeah, I think going forward, this is going to change this semi-urban. In our experience, it is because we are only 8% of our branches are in metro. Our majority of our branches, 77% of our branches are in semi-urban area, and majority of our deposits around 75% of our deposits comes from the semi-urban branches, and 95% of our deposits are retail deposits. So I think from the metro, the focus on the metro or concentration of the metro, because maybe the urbanization in India is also increasing. So more number of small towns will become urbanized. So more the semi-urban usage. From my experience, I'm seeing that the peripheral areas in a city to take because a lot of middle class is moving towards that, and the growing middle class is going to have more disposable income in their hands. So maybe I recently read a projection by 2050 there will be 78% of the Indian population will be the lower and middle income in the segment. So this LMI segment will both our asset business and both legs comes from this segment. That's my gut feeling, I would say. And my experience today proves that because we have around 75% of our deposits comes from 200 and plus 50% of our semi-urban branches. And some of the rural branches are also contributing very good in the deposits. But on the microfinance clients per se, and the deposit mobilization still to take a real momentum on they have accounts, but still they start with they depend on the loan. So we started a weekly along with their loan, they can pay a small amount. A weekly recurring deposit product we recently launched and it's getting momentum. And we need to do a lot of innovations in that space. And on the there are many innovations happen in the asset side in India, but unfortunately on the liability business product development, not much has happened in India, specifically because the same product which we are offering to metro customer is we are offering to a rural customer may not work. So we may have seasonal products, all may be required. And also the differentiated service, differentiated rates, differentiated service is required. So we offered a differentiated, all of us, most of the SMBs offer a higher rate of interest because our lending rate is also on the higher side. So we offered a higher rate of interest so we could attract a good chunk of deposits from, even from the first year itself we could attract. And especially there are a large number of pensioners and senior citizens. So they need differentiated service also. So we, especially in our case, we offered a doorstep service. We organize special events for honoring old age senior citizens. We have a project called Vayomitram. Things like that we launched. And also another perception about private sector banks, they charge a lot of hidden charges are there, because when we launched the bank in 2017, there was a lot of discussion about charges, hidden charges. So we waived most of the charges from the day one. So that also helped us to mobilize a lot of deposits. But it, to build a CASA, we are only 15% of our deposits are in CASA now. That is also majority, even 90% of the CASA comes from savings account only. So the current account deposits building up take time because they need a lot of other services, other product to offer. So we're growing. And for us, a lot of around 30% of our deposits comes from NRI segment, because our majority of our customers branches are in Kerala, and Kerala is a highly. But as I said, Sanjay earlier, banks needs a lot of investments in branding because it needs. We need to get trust. In last 20 years, we have been trusting people and giving unsecured loans. Now people have to trust us, but there is a story we can sell, and we launched a product for their deposits along with their financial returns. We share the social returns, the customers whom we serve, the data of the customer, and the social impact we create through that money. So we share with the depositors. So that really people appreciate that. So maybe we need to continuously innovate in this space.
Fabulous. Lots of interesting insights there. And I think want to underscore your kind of observation that we need a lot more innovation on the liability side. I think that's largely happened in the informal sector. If you look at the chit funds, the pygmy schemes, but they've all been in the gray sort of informal sector, and it'd be fabulous to see SFBs drive innovation also on micro deposits. Sanjay, turning to you, you've had breathtaking success on the liability side, but also particularly being a small business focused SFB as opposed to the other MFIs. Is current accounts a bigger part of the story? Have you done any product innovation on the liability side?
No, I think my colleagues would agree that the most toughest job in the journey of banking is to raise deposit, because actually every customer, when they ask, why should I bank with you once I have a relationship with, I actually have 100% confidence that, you don't have any account with your SFBs, So why Bindu doesn't have account with us? So everybody asks us, why we want to bank with you. Correct. So,
my father though is very interested to open an ESAF bank account, and I've encouraged him to do that.
Yeah, Bindu, and that's the reason is because he is more mature, right? So he trusts us. You don't. So and because I hope ESAF is giving him around 7%. Right? So it's very clear cut, strategy where you need to be very, very creative around your creative. I would say very, very imaginative around your working to attract deposit. The first foremost thing is trust. And you can't buy trust, you can't inject trust, you can't even tell people that you trust me. It has to come very, very automatically, very subtle in a long way. That is why we always say that a bank is a journey, not a destination. And I have one strong belief that, in a previous days, once, people like HDFC and ICICI started, They took long time because people need to see their seasoning and they see their product, see their offering, they see their how they actually survive in the testing time. But now, we are very lucky that in a digital world, the flexibility, the convenience, the security, the easiness, the imaginative, it can be a next trust. So, for example, I'm just giving you one example that, people might not be trusting Amazon or e-commerce 10 years back because they always believe that the product might not be right, the service might not be right, or they might lose their money. But now in 10 years, everybody is believing that Amazon, all those people are good enough. So I believe that digital will be the biggest equalizer for us, if we play our inning well or play our ball well, right? So we need to be very imaginative, and at AU we have done a lot of things. We have actually segregated our market from core to urban. Urban, as I told you, has little bit differentiated way to handle it because their people are high end. They require a lot of service, engagement, priority. And honestly, Bindu, deposits are very commoditized. You don't have that very scope other than the rates. It's highly regulated, right? So whatever I can offer, the HDFC Bank will also offer. So it's about the delivery rather than the product. So I would say we are really working on delivery, which is the seamless, which is easy, which is because we are also young, we have that we can bend ourselves, and we are more hungry. We have more purpose. So that's the way we are handling it. But I think a lot of method in madness, like go to urban, let's not build quantity, let's build quality. Let's be more engaging, let's be more engaging in the right communication, right? Like once we want to communicate with your father, right, it has to be very different way that we communicate with you. So I think there we can play a differentiation role. So I would say liability is a journey, right? We need to keep on working on our whole of imagination around product, delivery, communication, engagement, brand, digital transformation, So that's the only way we can build a liability. But I'm very happy the way we've done till now because being an SFB, because small word is also not helping us. And because generally people, and what happened to so many financial crises in last 3-4 years is also has not helped us. Whatever any bank happened, you always question SFB. And people generally ask you that you can't take high deposits or how you are secured, why you are small in return. So a lot of questions being asked to our team on the ground. So it's required a lot of seasoning, but we are very happy that because as NBFC we never able to do that, right? So I think we are working on both the aspect, is the execution of NBFC and the trust of bank. So we are fortunate that we have both.
Sanjay, your core, the MFI kind of customer base, I think the general view has been that their surplus and their ability to kind of meaningfully save is limited. Your core customer has been the small business. What is your sense of that customer's potential from a savings perspective?
So we also started with the wrong notion that, our asset customer, our loan customer will deposit the money. So these are two different two different people, two different verticals. So as of now, we are close to 30,000 crore of deposits. So it's just 10% is coming from our asset customer. And as you, you asked me about current account is more tougher because it's more tougher.
It's tougher, sure.
Because now the payment system are so quick.
Sure.
Why, and everybody understand that why he want to keep a money in the current account where you can't get any amount. Right? So people are actually in individual account. People generally keep floating the money within saving to current, right? And the money is available at your will, 24/7 RTGS. You can transfer internet banking, mobile banking at your will, right? So people are hassle free. So float in individual accounts are very less now, and the corporate accounts we can't go them because they require a lot of brands, they require a lot of loans which we can't give them. So current account is more tougher, but of course through the UPI, through the other payment methodology, you can make some easiness around your payment system, or you can actually hold the system and then enjoy, right? So these two things, were the mixed wrong notion which we built at the start of the bank. But now we are very clear that deposits a very different animal, and you need to keep on imagining around your needs and the customer needs, and then build on. So you have a lot of patience. You need a lot of patience to build a deposit franchise.
Thank you,
And
Sanjay.
once it's built, Bindu, once it's built, my colleagues know.
Sustain it, yeah.
Then you can enjoy for next 500 years. Maybe some other people, but that's our philosophy.
Right.
So we are doing all that hard job. वहीं पर हमारा खून और पानी और आंसू सब वहीं जा रहे हैं, So
right. No, and I think the results of that are quite visible. I think none of us would have guessed that in 5 years you could move the needle so much on liabilities. So that's, I think, really been heartening. And also, I mean, it also tells you something about the Indian urban consumer, middle income consumer, that everybody thought that those markets are very well served, and it'll be impossible to get somebody to switch from a public sector bank. But I think the openness that is being shown to bank, and including my father, who is super conservative, I think that's really been surprising to see that sort of openness. And I guess, people are conscious about price and rates matter. So the price-led strategy has, put you on the radar of the urban consumer, which is, I think, super interesting. Rajiv, quickly to you.
Can I give you father number, please?
Yes, Sanjay. Oh, yeah.
One customer for access. Wow, because of my 90-minute labor with you, right? Can I get
right. That's the least we can do to compensate you. So great. Rajiv, over to you on your thoughts on the, how is this evolving? Are you also, do you think the metro first strategy will continue?
Sure. So at the outset, there are always very similar thoughts, but let me just bring out two flavors, and both Paul and Sanjay alluded, and this also goes to your metro-led strategy. Clearly, the deposits are largely concentrated in the metro/the urban areas. So we are not changing the dynamics of it. So there is a lot of deposits coming from those areas, and it in a longer vision of the bank, when you put about 10, 20 years, we would clearly want to match our asset centers and our asset strategy and a deposit strategy, so that you have a more complete branch and a more synergized set of customers that you're working with in a branch. So it is not a long-term destination to have a lot liability-led branches or a lot asset-led branches. The difference is too stark right now for obvious reasons. So when we think 10 years to 20 years forward, I think we'll get closer to that. But in the short term, in spite of our best effort, and for the reasons alluded by Sanjay and Paul, the kind of disproportionate effort that you'll put in to get to a higher mix in the semi-urban or rural areas will not justify that effort when you're doing a lot more to build out the short-term liability game plans at the right cost to serve and everything. So in the short term, I do feel more aligned to a little bit of Sanjay's, and frankly, Kerala is very different. Kerala is pretty much, we can call it all metros or all urban. So maybe Paul's example has to be taken a little differently. But when you get to the rest of the country, Kerala is very unique. So it's actually Kerala and rest of the country, you can call it that way. You have to be a lot more invested in the metro and the urban branches for your deposit strategy. Otherwise, you'll have short-term challenges. Nobody disagrees with a 5 to 10 year forward view. The second point which Sanjay made on the customer overlap, of deposits and liabilities. Now, it's a very interesting point. Actually, it's an insight point, and it's not about, I would go back and challenge that a lot of the bigger banks would not also have a very big overlap, because it's a principle. Once a customer takes a big loan from you, he's very likely to be a very small saver with you, because customers do not have, they can't service a 15-20% rate on one side and earn 5% on the other side. So typically a customer, leaving out small loans here and there, somebody could be a small auto loan and be a big saver on the side, which is a small point in a larger bank context. Typically a customer in their life cycle is either a loan taker or a deposit creator for the bank. And the cycles change, and we ourselves have gone through the cycles. So it is not that all urban customers are deposits creators, and so therefore there is what the bank, a successful bank will achieve is when in a customer segment you are agnostic. You say, look, I deal with 100 salaried customers of this company, and in some phases some of them will be depositors and some of them will be asset takers, and they might switch between them. But my strategy is to work with the same set of customers in a complete value proposition, and they will change roles along the way. So the strategy is aligned, the positioning is aligned, a lot of things are aligned, but it is not necessary. And data of most of the small finance bank, what Sanjay said, and even when you go to the universal banks, I would say there may be a 10-20% increase in asset customers holding deposits, but it cannot be, a segment of customers could be equal, but it's not the same customer who would be having large amount of deposits. So it's quite rational out there. An example, somebody takes a mortgage loan, he will never be a depositor with you because he doesn't have that much liquidity to match a mortgage loan. Those were from the two insights that were brought out. At a conceptual level, deposits, the pricing is a key play in there, and I can talk about that, but fundamentally it needs a reach. You cannot raise deposits without a reach. And all customers, when we talk of trust, the one of the big variables in trust is, can you see a branch? And if a customer can't see a branch, he can't trust you. Whether it's especially senior citizens, the youngsters can take a call on opening accounts on the net. But also remember the irony, as bankers, in the recent past, you learned the money also lies a lot with the senior citizens. The money doesn't lie with the youngsters. So if you're after the money, you should be after 60-year-old plus, 50-year-old plus. If you're after 20, 30 years old, they are spenders, they're transactors, they are probably loan takers, but they're not depositors. For 100 set of youngsters, 100 set of senior citizens, I'm telling you, you'll get 10 times the money from this. And the youngsters want to invest in stock market, mutual funds. They have alternate desires. The senior you say, I want to be conservative in my investment decisions. So again, the focus towards senior citizens is not a bad. All universal banks have that for their deposits, and small finance banks, because they were so focused as a deposit strategy, they went towards senior citizens. So one, branches are key. So reach is key. It is not like you need hundreds of branches, but you at least need some minimum number to create the trust and for your employees to work from and the customers to work from. The second one is, I would say, when you get customers, they don't just walk in. Frankly, our teams that we have hired, quite a few of them have had relations with the customers. So the initial contact with the customer is the key. It's not easy to get a cold calling done and somebody will trust you with their money. So I think building a good team which has past relationships or can create good relationships. It's a very deep hard sell. It's a very, you have to sell from your heart. It's not easy to just say, trust me. So a lot of work has to be done. It was alluded by Paul in terms of activities. Sanjay does the same thing. But just trust has to be built over a point of time, and opening relationship with customers is a material importance. It just helps make the whole sale process simpler. The third one that you talked about is a rate. I would say, without a rate, your door will not even open. You offer a similar rate, they'll say, look, I trust HDFC Bank more, ICICI Bank more. Why should I take a risk on a small finance bank? Luckily, in a business model, we can afford to give a slightly higher deposit rate, and therefore there is a degree of sustainability in our strategy. So rate is a door opener. Without a rate, you cannot just, the whole deposit strategy will not work. And the last thing I want to talk about in that is technology. Technology plays two roles. If you are a paper bank, the customer doesn't have the time to create papers for you, fill out forms for you. They'll do it for the bigger banks. They'll do it for a PSU bank. Why should they waste their time and energy doing it for, getting a little bit of a pricing advantage from a small finance bank? So technology is the key, and technology is not just for convenience. Technologies also help build trust. In today's context, if any one of us can open an account for the customer doorstep in about 5 minutes, can you imagine the amount of impression that we create? If we can open your account in 5 minutes or 10 minutes and make it a fully operational account, we must be really capable. We cannot be a fly-by-night operator because these things don't happen that easily. So I would say technology for the convenience factor of it, and also the technology for the trust factor of it. So when you put all these variables together, and you just keep on working on it. It takes a little time. It is a lot of time. It's a journey. As Sanjay said, somebody will work, somebody will reap the rewards. So, but fundamentally it takes time. But I think with a pricing advantage, we can build it a little faster. And if we don't need to build it at fast, we can obviously slow it down by reducing the pricing differential that we offer. So we have the ability to sort of, moderate it up or down depending upon the need of the bank.
Right, Rajiv. There's some fascinating customer insights and a good reminder that it's not quite the same customer who is, kind of double hatting a saver or borrower. There are multiple segments. And I think the whole senior citizen story has been an unexpected good outcome of SFBs. I mean, I'm sure RBI didn't think that that was going to be one of the social impacts of SFBs, but I think you found a nice opportunity, and as Rajiv, you said, rate has opened the doors, but then beyond that, it's really all the hard work of making a good impression, that you're reliable players, that you have physical network, and so I think winning trust takes you on that whole journey. The final kind of deep dive I want to do with all of you, and then open it up to the audience, is on the loan book. And I think there we have, a little bit more variation than the liability strategy. So this is the picture in the green bars are 2018, the orange bars are 2020, share of microloans in the overall portfolio. And this is different SFBs. AU stands out as having never done microloans. If I look at ESAF, for some reason, I don't have your numbers. Maybe Paul, you can speak to that. But it's still, more than 90% of your overall loan book. For FinCare, it's declining rapidly, but still about 80%. So if I can turn to this question now, starting with you, Paul, how do you see this evolving? Do you think different SFBs are going to specialize on the loan side as well? Will somebody like you, for example, continue to be a microloans dominant player on the asset side?
Yeah, for me, I think do what you know, focus on what you know better. So that is a strategy we have taken, and on the asset side, our strategy we have taken is that grow with our customers. And their aspirations. So we'll become a family bank for our micro banking customers. So there we have given a microfinance loan to the women, to the lady. So her husband needed a three-wheeler loan. So we are exploring those options. And then as their income levels going up, so my micro group loan, they graduate to micro enterprise loan, which we have created a 3 to 5 lakh rupee loan. Then next phase of MSME, defined MSME loan. So I'm seeing that, and there is a huge potential for that market. And that segment of customers, we know them very well because we have gone through multiple cycles of challenges and take it, demonetization, flood, Andhra crisis, all this, we have gone through all these set of crises, and we are confident of that segment. So we continue to focus on that segment. At the same time, and it's a diversification for us, we see it as a byproduct. So we started with my group loans. We introduced a individual micro enterprise loan and an MSME loan. And the same customers asking two-wheeler loan, car loan, home loan. So we started all these products. So today we have almost 90% of our loan is on group loan, and 10% is on the other loan. And another loan we started is we have the branch network, and gold loan is very popular among, especially in the markets where we operate. So we started the gold loan, and gold loan is growing fast. Gold loan book is growing. So that's one area we will be. So as our capability, internal capability building is also very important. So as our risk-taking abilities, the team building will happen. So we will slowly diversify. That is our plan.
That makes a lot of sense. So really kind of follow the customer and complete that cycle of needs. Rajiv, turning to you, that's still a pretty important product for you. Somebody once told me that, microloans, ATMs, we know that they will eventually disappear from the landscape. But when is the million-dollar questions? It could be, the next 5 years, it could be the next 30 years. These things have a long tail. As you look to the future, is microloans an important part of your asset strategy? And what's number 2 and 3?
Sure. So just on the lighter side, I think I can still see ATMs disappearing at some point of time, the way our payments have ramped up in various ways. Microloans, I think things change. They may change formats. They may not be called microloans. They may become individual loans. There is a lot of unmet demand. So microloans as a microloan strategy will not change over the next 5-10 years. There'll be some changes, but I think in this format, they can still survive a decade. And beyond the decade, as the affluence picks up, there can be other forms of loans. And as Paul said, once you start adding other products, they'll move towards an individual loan, but the customer segment might still be the same, till the income disparity goes down and they really come up these strata, which can take decades. So at least the way we think, this industry has been in existence for the last at least 20-30 years, at least 20 years very actively in the country, 30-40 years outside. So it's a very long cycle industry. It's seen multiple cycles out there. So we are quite comfortable in believing that this product will be an important product for the bank for the future, for the next 10 years also. Now, the question is, what is the right mix? The bank should diversify, not because microloans is a bad product. Sometimes people ask this question of context, oh, this is a problem. You have 80% microloans, so, COVID happens, so you have a problem. If something happens, you have a problem. In theory, it's a concentration risk. So I'll explain to the concentration risk, but has microloans to be proved to be so bad in the last 10 years when you look at long-term averages and look at the losses and you say, oh, you know what's been worse than personal loans, worse than credit cards, worse than something else, and you come back and say it has been much better. And if you look at COVID phase, when you look at the first few months of coverage, microloans is the biggest risk out there. And today you see microloans has probably the highest collection efficiency, probably after affordable housing. It has a higher collection efficiency or a reasonably high collection efficiency. So I would say diversification or reducing microfinance on the balance sheet is not about moving away from the belief that it's a bad product or a high risk product. It is because of the key thing, what everybody calls diversification. A bank sits on depositors' money. And when you sit on depositors' money, you have to run the institution where you can almost, with a very high degree of confidence, certify that the depositor's money is safe. The capital that the bank has enough cushion to absorb any risk on the loans that the bank has done. Now, if you have a concentration risk of any kind, it could be of personal loans, it could be of housing loans, it could be of any kind. Then you start becoming risked. You're not diversified enough for making that statement. So diversification for a bank is critical because that is the responsibility that you have to discharge as a bank. Because of the depositor's money. When you are an NBFC, you have equity and banks have lent to you with open eyes, whereas the depositor is not giving money to you with a thinking. It is your responsibility to diversify enough. So we have to diversify enough, not walk away from microfinance because, it's a higher risk and we should run away as fast as we can. It's actually one of the safer products as I look at in a long history of the product. Now, what is the long-term destination? The first clear destination for MFI converted banks is to reach a 50% mark, and we should reach there sooner than later. And the second one, I think, a core product of a bank, typically speaking, when you look at it, is about a 30-35% of the bank's balance sheet. So when you look at the banks, typically it's mortgage, but you wouldn't be surprised if a bank has 20% or 25 or 30% as one core product. So I would say if we are good at what we do, we believe in the product, there is no reason to bring it down lower than 30 odd percent or 35 odd percent in the long term, unless dynamics change, product behavior changes, the need changes, as you go forward 5 to 10 years. And the alternate products, we have started doing, loans, SME loans, we can call it loans against property. We do affordable housing, we do two-wheelers, we do gold, but in lending, you have to be careful where you lend, because you have to build the risk expertise, you have to build the collection infrastructure, you have to select the customers well. The value proposition has to have a positive selection of customers, not just the worst customers in the market. So because of the responsibility of good management of losses, we have to build it carefully. Speed is not of essence in a loan book buildup. It looks good in the short term, but it can hurt you very badly. So you have to believe the speed that you are at is the risk you are capable of managing the risk at that speed also, and therefore it will take and microfinance is not slowing down. So I always tell people that to get to a different percentage, either microfinance has to be artificially slowed down, or you have to grow faster than the microfinance rate. So if microfinance grows at 40%, the other products have to just go faster. So it takes time to diversify. So in a nutshell, I think we'll get to a 50% alternate products and maybe about a 60-65% over the next 5 to 10 years. But it's going to be relatively slower, 5 to 10% swing every year. And we will get there by doing the other products sensibly, because we understand microfinance and we are very good at it. And we also understand the other products, but when you're a new market, new player, you have to play the risk very well. You don't want NPA creation on your bank.
Absolutely. I think that's very good thinking. And I think when we talk about the microloans, 100% agreed with you that risk-adjusted returns have been quite superior. There's been a lot of event risk. But then if you look at it over a longer period, even 18 months post-events, collections are robust. Because the other thing we think about is also, will consumer behavior change in fundamental ways? With more urbanization, are people less likely to show up in groups and maintain the same affiliation? That's the other dimension that one thinks will change over the next decade. But great to see that it will be an important part of your journey. Sanjay, turning to you, I actually don't know much about what your loan book looks like, so maybe you can share with us. I remember 8-10 years ago, you visited us in Tanjavur to say, I want to understand how this gold loan business works. I'm sure you've done a cracking job of it. But what is the composition of your loan book, particularly since you are a small business focused player?
Yeah, so on a data side, we are around 40% is around wheel. In wheel we cover everything from two-wheeler to 20-wheeler, right, from commercial, personal, captive, taxis, whatever, right? So we cover everything on wheel. So which covers 50%, 40% of our business, and which is our bread and butter because we are doing from years. And then 40% odd is around SBL, small business loan, which we are all talking about. Is it the roadside, kirana shops, service centers, computer shop, whatever, right? It's more of an MSMEs, micro, small enterprises. So we cover them well from last 10 years. We also restarted our housing. So these are three prime products which we want to really build AU. Other than that, we do the commercial banking around business banking and agri banking. So these two verticals are also coming up. And there we actually service on the basis of balance sheet, right? So there has to be a tier 1 kind of customer, but might not be a customer who go to the higher banks. It's a customer which we can actually engage and can do service. And then, of course, the smaller one like PL, the gold loans, maybe consumer durables, and maybe some affordable housing projects. So they will do because of the branch banking affinity, because a branch banking customers, a customer who gives you liability, somehow looking for a small personal or small tenure, might be looking for a gold loan, might be looking for consumer durables, right? So they will do a very small proportion. So
Sanjay, how do you meet your agri targets under PSL?
Yeah, so entire wheel book, which is close to 75% wheel book is priority sector. The SBI 75% is priority sector. The business banking, the SMEs and MSMEs is priority sector, right? And We also do the agri banking. So our agri book, agri classification comes from agri banking book, and of course, whatever the subclasses, the sub use of the wheel book and SBL, because SBL means that if a customer is agriculture, right, and he requires money to build his own warehouse, or he requires a tractor, or he requires something there, that is classified as an agri. So we are not in direct core agri, because as we all, SAB don't have that benefit of interest subventions, so which senior banks has. So we actually get discouraged on the ground to lend around the what you call the KCC. So, but we are evolving ourselves. So, but other than microfinance, honestly, I do everything. And as Paul Saab commented earlier that you do what you know, right? So we are really focusing on that. And in journey, as I already told, is journey of infinite. So we will do microfinance as we get more matured, our balance sheet get more strength, and I meet Rajiv more and more, right? Because I don't meet Rajiv more and more, so that's why I don't get. So yeah, so I think that's the way I do it. But I think Bindu, the larger part of asset, as I've already communicated, that for me the financial inclusion happens once you do loans, and loans to the business people, right, who earn the money. So the AU focus always remain that our loan should be productive. People should earn. So like once we started our journeys in NBFC, we were doing for the taxis. So the people will actually started with one taxi, and after 20 years of my working, 25 years of my working, people have taken 5-6 taxis, right? So that has given them extra money in their family. They have taught their children, and they are so well do now. So that's the whole idea of a banking, honestly. So, so we believe that the design of a bank, design of SFBs is also to allow customer to grow with you, right? And I'm very proud to say you that AU has done tremendous job in the last 25 years around our sector, right? And microfinance, unfortunately, we were not there, so we don't have the confidence, but maybe in years to come.
No, fabulous. Thank you very much. And like you said, these are, hopefully 100-year institutions that you're building, and this is just 5 years. 500. Got it. We have really good questions from the audience, so I want to dive right into it. Abhishek from Axion asks, do SFBs feel that they are at a disadvantage in any way relative to a universal bank, or actually have advantages? How important is it to have the universal bank in the long-term strategy? If I can ask Rajiv to quickly respond to that, and then I want to get to more questions.
Sure. I would say, we have enough of a regulatory space to build the bank that we are building. As Sanjay said, an NBFC was a very small organization in terms of its complexity, and this license gives us enough to work on the deposit side, enough to work on the asset side, the payment side. And a lot of times it's all about specialization. And so in the short term, 5 years, 10 years, I think there's enough to do. The opportunity to convert may come early, and each one of us will take a call because there could be some strategic advantages of converting to a universal bank license in some of the regulatory framework. But if you ask me, a lot of us, are quite confident that we have enough of a regulatory space to sort of, operate and do our loans. In terms of advantage and disadvantage, I think no major disadvantage. They are doing what they do well. They are the large banks. They do corporate loans. They do investment. They do all kinds of things. And the space that we operate, we were not competing with them when we were an NBFC. We're not competing with them a lot in the asset side even right now. In the deposit side, there's enough to go by. So I would say there is no major competitive advantage or disadvantage. There is enough to do. The license gives us enough space. It removes a lot of risk which come because we are deposit taking. So it has cushioned us against those risks. So enough to work with.
Excellent. Thank you.
Just to add on this, there's a famous saying, is a half full glass, right? So what you want to see is your own way to see it. So I will say this is a glass half full, right?
Right. I mean, and I think to Rajiv's point, there's just so much to do. And And it may be that RBI is looking at this as a bit of a funnel strategy to say the banks of the future have to come through successful execution on the SFP. So, some may be universal banks of the future, but it certainly seems like there is more than enough ground to build, very valuable SFPs. There's a question for Sanjay from Misha of Dwara. Has AU thought about innovative savings products that appeal to low-income households in addition to the overall current liabilities? Do you think that's feasible? Is there a way to design good savings products for the informal segment?
Yeah, so again, I will say that because we are just started our journey, right? And we are just learning how the deposit will come and from where it will come. So, and the market which Nisha, right, is indicating is not easy because I personally believe that households should have some more income level to do some saving, right? So I would rather focus to do them loans. And of course, because generally people say they don't have a saving habit. It's not like that, honestly. They don't have money. And if they have money, they want to actually look for a better returns. And we, unfortunately, as a bank, only gives them 5-6% by design. We can't build our own rates or our own products. It's very, very regulated. So
I think the other point, just to add to that, Sanjay, in rural, overall, not just low income, but rural, a lot of the assets are actually held in physical form. So you have house, land, these are 90% of balance sheets of household. So unless you find a way to, in some sense, convert the physical into financial, just your cash flows are not giving enough surpluses, right?
No. So I completely understand. So I would say that the world has moved a lot in last 10 years, So every asset, honestly, the customer has is mortgageable. So we are doing that SBL loan is on the Gram Panchayat, on that all those properties where people can actually get the loan against that. We're actually lending them money through various schemes of government, through credit guarantee schemes or Sunidhis and all those stuff. So I honestly don't believe that there is a lack of finance. It's a lack of opportunity to how to make your life more cash surplus, right? So the people have narigas, people have a lot of other aspects, but unfortunately, our per capita income is so low that whether people really want to use for their own consumption or they really want to do for savings, But I would say we are in journey. We are reaching there through our different channels, whether it's in BC, whether it's in BO, whether it's in branches, and that's our duty also as a bank, that we should be present in those markets, explain them about products, build a delivery model which is easy, convenient, and because they need to be very understandable also. And you will appreciate that bank only works around 23-4 days, so those people actually get vulnerable because bank is off, bank is on holiday that particular day, so they don't want to keep money because we don't have ATMs everywhere. So I think, I think the whole work is in progress, and I would say SFBs in next 10 years will play a very, very important role to build a very decent franchise around these markets. That's our duty. That's our whole design also. So we appreciate that, if somebody helps me out to build some product, we are very open to that. And we are doing
I'm sure Misha will take you up on that offer. Question for Henrietta from Henrietta of Habitat Microbuild. Has your institution been able to tap into your existing microfinance customer base for other products? Paul, if I can turn to you, you already spoke a little bit about it to say two-wheelers, housing, etc. In general, what's been that cross-sell experience on the asset side?
Yeah, it depends on the cash flow. We are giving the other loans based on the cash flows of the customers. So we made products available to them. We did continue to do focus group discussions with our micro banking customers on a monthly basis. But personally, I am attending those meetings now. because of the pandemic, people are also well versed with the online platforms, so that it's easy to have these discussions, and we are understanding their requirements, and we are modifying our products. So we have a micro housing loan product, we have a two-wheeler loan product, a micro enterprise loan. So all these products are mostly designed for the existing customer segments. So, there are many cases. People are slowly graduating. So I can just one customer always comes to my mind from Nelambur in Malappuram. So she has started with a 20,000 rupee loan in 2012. So she started a micro business of making floor mats by cotton waste, with the cotton waste. So her business has grown. 2 years before, she has taken a 6 lakh rupee micro business loan from us. She built a shed. She is employed 20 people. She gave employment. Then a few months back, she asked for a housing loan. We sanctioned a 13 lakh housing loan to her. So that is a story. So we have the products ready, and we are working with our customers, making awareness. And financial education is very important to this set of customers. Help them to plan for the future. And all these assets are their reverse saving, actually, as you rightly said, Bindu, earlier. So that savings is mostly on assets.
Right. Very insightful. I want to take 2-3 questions and kind of combine it. We don't have time for a response, but I'll just share with the panelists that there's a lot of curiosity about who do you think of as competition, particularly because you have a different play on the asset side, different play on the liability side. So there were at least 3-4 questions. Unfortunately, we don't have time to get to it, but around understanding the competitive landscape. And it's interesting that you are actually straddling multiple, institutional types, and therefore your competitors also will vary. We have just about 2 minutes left. So, obviously wanted to talk a lot more, and it's been fascinating. But a few things that I definitely took away was a sense that, the 5 years has been truly blood and tears and just getting things off the ground. And the strategies that we see today may not be the equilibrium strategies, particularly with respect to products and branches. A few of you said that you expect a little bit more convergence, going from the Robin Hood strategy to a convergent strategy, potentially around the semi-urban market, not so much the core rural, although there will be continued overlaps. And of course, there was a lot of emphasis on learning as you go and just sort of imbibing all of the innovations that come along the way. But a big congratulations to all of you for making this journey, and to your teams for executing so well. I think the audience will agree with me that as we look at the post-COVID landscape, the fact that we have 10 solid institutions in the SFB category and many NBFCs, of course, I think the recovery for the informal sector will definitely be, everything else remaining equal, better because of the fact that they can access institutions like yourselves. So thank you all for sharing your thoughts and time so generously. And I also very much want to thank Access. In a year and time when everything is changing, I think it's almost comforting for us to be able to get together on this forum that has been so successful over the years. And it was a real pleasure to moderate and meet all of you. Thank you, Arya. Let me hand it back to you.
Thank you, Bindu.
Thank you, Bindu, for the very engaging discussion. And I thank the panelists, Paul, Sanjay, and Rajiv, for their insightful contribution to the discussion. I'm sure the participants and delegates would have found it really interesting. With this, I formally close the discussion. For the participants, we will take a short logistical break for inviting our other panelists in the session. Please join us at 3:50 for the next session on adopting sustainable finance tenets. Thank you.
Pocket and the ability to spend it in a way that's best for them and their families.
They said love, don't fail if you're trying. I knew in my heart I would succeed. When times get hard, gotta keep on fighting. Keep on fighting. All these battles, yes, they made the best of me.
The world has changed in ways that were unimaginable a year ago. The challenges facing our society, our economy, and our planet may seem endless, but so are the possibilities. This is a reset moment. At MasterCard, we see a future where people can reach their full potential, where economic growth is inclusive, and where the planet thrives. By applying the full strength of our resources and network, we are working to advance digital inclusion. That means bringing 1 billion people into the digital economy by 2025, including 50 million small businesses, with support for 25 million women entrepreneurs. We believe racial and social equality empower everyone to reach their full potential. To help level the playing field, we're clearing roadblocks for Black business owners to build and grow thriving businesses. Because acceptance matters, we now offer the True Name Card, which allows transgender and gender non-conforming account holders to put their true selves forward. We're also working to build a future where communities flourish and the planet thrives. Together with our partners, we have pledged to plant 100 million trees over 5 years to help address the urgent climate crisis. In our deeply interconnected world, we're at our best when we face challenges together. And that's why we're working to build a stronger, more resilient, more inclusive digital economy that benefits everyone, everywhere.
My name is Elsiwan Horam. I'm 36 years old and I'm running my small shop. My business is much better. I learned that as a business person, if I want to become a successful person, I'm coachable and determined.
After the financial education, I know the right source to get the money with low interest. Right now, I'm struggling hard, but then in 5 years, I'm sure I'm going to build up a big food processing unit.
I kurai konjam lekai dagini, I ahambada phak amina sajarami, training chatla matung dagidi, I products kaunache makhan saba, bag sare, button sare, spine cover che, I know saba dagidi, order mina matang tawire.
Before I attend that training, I didn't maintain records for budget, but after that I started maintaining records for monthly. I started writing monthly expenditure and monthly income. I used to keep the records like that.
जिंदगी इन पहाड़ों की जैसी है ना, क्या पता कौन सा मोड़ कहाँ ले जाए। मेरा नाम तनुजा है और मैं सिरपुर गांव की रहने वाली हूँ। पापा डेली लेबर का काम करते थे। घर में मम्मी, दादा दादी और छोटा भाई रहता है। 6 का परिवार। और कमाने वाला सिर्फ एक। हर दिन मैं घर के काम करके स्कूल जाती थी और फिर लौट के खुद की पढ़ाई। मुझे ज़िंदगी में कुछ बनना था और फैमिली ने हमेशा मेरा सपोर्ट किया किसी भी हालात में। 12th के बाद मेरी फ्रेंड ने मुझे स्वतंत्र प्रोग्राम के बारे में बताया। पता चला वहाँ मेरे जैसे स्टूडेंट्स की करियर ट्रेनिंग होती है। वहाँ मैंने होटल मैनेजमेंट की ट्रेनिंग ली और मैं यूं निकल पड़ी, पीछे मुड़ने का नाम ही नहीं लिया। और सिर पर भी बदल रहा है, लड़कियां करियर के बारे में सोचने लगी हैं। आज मैं होटल के फ्रंट ऑफिस का काम करती हूँ, आगे जाके जनरल मैनेजर भी बन जाऊंगी, पक्की बात है। मम्मी पापा ने कभी साथ नहीं छोड़ा और ना ही छोड़ेंगे।
अभी तो सिर्फ स्टार्ट किया है, पिक्चर तो पूरी बाकी है।
Across Delhi continues to be grim as pollution levels remain sky high. Delhi Heights woke up to another morning of dense smog. However,
winter is my favorite time to visit Delhi. However, in recent years, these months have seen a sharp spike in air pollution. As we're driving around the city, you can actually see the smog. I think everybody realizes that this is becoming a problem and it needs to be addressed. But change is happening in India. How we tackle environmental issues is taking center stage. To find out more, I'm meeting Tarun Balram, who is heading the Sustainable Finance Priorities for HSBC India.
So the government has made strong commitments to reduce carbon emissions. 40% of the installed capacity by 2030 will come from non-fossil fuel-based energy sources. So our priorities are to be a leading bank in the sustainable finance space, integrating climate risk into the way we work. For a bank like ours, which has a full service platform in India and can cater to the needs of a client in this sector across the spectrum, it's a great opportunity.
I'm here to visit a client that is part of that change.
Energy is extremely important for success of India's transition from emerging market to a developed market. Now, when you look at the different sources India has available, it's by definition solar is the most promising because it's available everywhere and you don't have to pay anyone for using sunshine.
We are on the rooftop in the middle of Delhi, which is one of Azure's rooftop solar capacity installation. This is one of their smallest installations with a capacity of about 1.6 megawatts, which can power about 400 to 500 homes. So we issued Azure's first green bond in 2017 of $500 million. What the green bond did was allowing them access to capital, which could help them grow their portfolio. So HSBC has primarily given a lot of these renewable companies access to a large pool of international investors who want to invest in projects which make a difference to the community at a cost which makes sense to the company and as well as returns which make sense to the investors.
We're a 10-year-old company and today we are a portfolio of 3,000 megawatts. We think we can do 10,000 in 20 years. Ultimately, we want to make sure that we are providing clean, low-cost energy for Indian consumers and helping the government meet its objectives on socially inclusive growth through clean energy.
It is inspiring to see change in action. Companies like Azure prove that clean power is possible, and it makes me proud that HSBC is part of it.
आप लोग जब भी रिक्शा चलाओ तो 3 बातों का ध्यान रखना चाहिए। पहली बात रेस, दूसरी बात ब्रेक और तीसरी बात ट्रैफिक नियम। मना ही किया था, घर में परिवार वालों ने तो मना किया था कि ये तो ना आदमियों का काम है, तो आदमी करते हैं रिक्शा चलाने का काम।
Thank you. Hello everyone, this is Shreya Kaushik and I'm the program lead for responsible finance at Oxfam India and also the lead for Fair Finance India. I'd like to thank each one of you for joining us this afternoon for this technical session on adopting sustainable finance and making the business case for ESG investing. Very briefly, I would like to give a brief of what Fair Finance India is. It's a civil society initiative that seeks to strengthen the commitment of financial institutions towards various social, environmental, and human rights issues. And it is essentially there to promote transparency and responsibility in the Indian banking sector and support its own sustainability. We are very happy to co-curate this session with Access. The session will be moderated by Mr. Shankar Venkateshwaran, who is the co-founder and head for the EQ Climate Finance and also the board chair for Oxfam India. The panelists include Mr. Royston Braganza, CEO Grameen Capital India, Ms. Wei Yuan, Asia Lead for Sustainable Banking Network, and Mr. Arindam Datta, EDN Head for Rural Development Banking at Rabobank. We look forward to this insightful discussion, and I request the audience to please feel free to put their questions in the chat box. And with this, Shankar, I hand over the session to you. Thank you.
Thank you, Shreya, and good afternoon, good evening, good morning to all the participants. I understand there are several from places outside of India, so welcome to this session on adopting sustainable finance and making the business case for ESG investing. So I have a great panel with us today. As Shreya briefly introduced, we have Wei Yuan from IFC, Arindam from Rabobank, and Royston from Grameen Capital. What I'm going to do is to basically give the floor to them because they are the experts. But let me just start with some opening remarks on the state of play of ESG, particularly in India, but also trying to look at it more broadly. One of the interesting encounters I remember having with an investor from a large financial institution a couple of years ago was that he told me that investors are driven by fundamentally two emotions. So he said that the two emotions are fear and greed. And fear is what results in them looking at risk, and any form of risk is what feeds into the fear emotion, and all opportunities to make money feed into the greed emotion. So that's a very interesting. He had a very interesting perspective on how investors look at it. And when you look at it, when you put ESG into the mix, you can see how it plays into both. And I think there's an increasing realization globally that ESG factors, the environmental, social, and governance factors, contribute both to the risk of an investment or a lending, as well as the opportunities to to sort of create wealth and increase GDP and all the and economic growth. So ESG is certainly the new kid on the block, so to speak. But having said that, I think there is increasing evidence globally that it is not something peripheral anymore. It may have been that 15, 20 years ago. It is certainly not peripheral now. And there is increasing evidence that shows that ESG is very central to the way the financial institutions look at their operations. So if you look at something called the UN Principles of Responsible Investing, it has so many thousands of members who are members of PRI, who basically sign on to PRI saying that they would use responsible investing, ESG principles in the way they invest, and they control over $80 trillion the assets under management with them. And I think there was a study that was done a few years ago that which McKinsey had done, which showed that about $30 trillion have been deployed in ESG, keeping ESG in the center of how the investment happens. So it is clearly very mainstream. If you start looking at all the major global reporting frameworks, whether it is CDP, whether it is GRI, integrated reporting, TCFD, all of them fundamentally are coming from the investor lens. It's investors who are saying we need to know more about what is happening. And we need to know more about an ESG dimension to this. So clearly, ESG is no longer peripheral. It is very much mainstream. It is driving the way investments and lending happens going forward. So that, I don't think there's any two ways about it. In the Indian context too, it is clearly becoming mainstream. I can certainly tell you about my own personal journey. I've been working with the Ministry of Corporate Affairs for the last 10 years on trying to get sustainability, responsible business, ESG onto the main agenda. So some of you may have heard of something called the National Voluntary Guidelines, which were put out in 2011, where I had the privilege of being part of the drafting committee, which led to something called the Business Responsibility Report that SEBI mandated initially for the top 100 companies, then the 500, and now the top 1,000 listed companies. We have a new version of the NVGs called the National Guidelines for Responsible Business Conduct. Again, I had the privilege of being part of drafting that. And we have a companion reporting framework called the Business Sustainability and Responsibility Report, which SEBI has put out for public consultation. So you can see that even in India, there is that increasing understanding that this is core to how we need to run our business, to run for the country to be on that path to sort of sustainable development going forward. And all this, of course, links very closely with the SDGs, and we're going to have our panelists speak to that. So what we're going to try and do in the next hour and a bit that we have is try and get our panelists to contribute their own thoughts, their experiences to some of the kind of questions that we want to tease out. So what is the role of the financial community in promoting ESGs? So we will hear from our panelists on their thoughts on that. What is the business case? Why does it make business sense for the financial institutions to put ESG into the core of how they go about doing their work, whether it is lending, whether it is investing? We will try and understand some of those trends there, some of those experiences there from our panelists. We were hoping to have one or two regulators on the panel. We could not, they were not available. But again, our panelists have been dealing with regulators a lot, and we will try and tease out some of those experiences also. So while we speak to the panel, and I'm going to put them questions to them for which we will seek their responses, I urge you, as Shreya said, to keep putting your questions and comments on the chat box. We have a team behind who will sort of compile them together, and at appropriate points, we will lead them to the panelists. So with that, let me start with you, Wei. So I think, the work that you do with IFC is very, very interesting because it is Asia-wide. And I think let me start from that perspective. Global and Asia sort of perspective. What are you seeing in terms of trends in ESG investing? Where is that whole agenda headed from your vantage point, right, for you?
Yeah. Thank you, Shanka, for that very good opening remarks. I think that very well set the stage for this discussion. Good afternoon, everyone. My name is Wei Yuan. I work with IFC's ESG department. And the team I wish ESG advisory services. Just from my perspective, I've been seeing two interesting kind of a ESG trend at two levels. One is through our advisory services. We've been working across Asia with the financial market regulators and central banks and banking associations for market level sustainable finance policy guideline development or voluntary standards development, which is usually then led by the banking association. We're also working on market capacity building, on ESG integration. This is pretty much focused on the banking industry and also supporting individual financial institutions, again, focus on the banks in adopting international best practices on environmental social risk management and ESG integration. So this is the country-based program being involved in across Asia in multiple countries. At the global level, through the Sustainable Banking Network, this captures a bit of a global trend. This is a network, again, of central banks, banking regulators, and banking associations from the emerging market, because IFC's mandate is only to work with the emerging market. It was, when it was first set up in 2012, it was a small network of like-minded financial market regulators saying, why don't we just form a kind of a knowledge network to start understand sustainable finance? It was 10 countries, mostly from actually East Asia, including China, Indonesia, Vietnam, Mongolia, Philippines, and Thailand at the time. Now, last week, we just welcomed another new member from this region, from South Asia, Maldives Monetary Authority. So that's the 42nd country joining the SBN network. So the network has expanded significantly. And just a quick numbers, overall, this is 59 members, including, because from some countries, it's like more than one member. Some of the stock exchanges are also joining from 42 countries. And collectively, those members can impact banking assets of over $43 trillion. And that represents about 86% of all the banking assets across emerging markets. Not all members at the same development stage. We have a global report to capture member progress. As of the 2019 result, 22 countries have introduced national sustainable finance guidelines or policies or framework, different types of documents, either regulatory or voluntary. But in this region, Asia, we're seeing a lot of regulator-driven action. There seems to be a preference for regulator-driven actions in Asia. Well, in Latin America, we clearly see a trend of a more market-based approach led by banking associations. So there's huge progress over the past, 5 to 8 years. I guess I'll just stop here, and then happy to take questions or continue a next round of discussion.
Yeah, sure. Thanks, Wei. We'll come back to you, but I think that was a very good, broad sweep of where we are. And I think it was interesting that you mentioned about how the Asian region likes regulators to play a more active role. So we should come back to that and discuss that a little bit more going forward. So we'll do that. Royston, may I turn to you? First, perhaps you can just give us a overview of what Grameen Capital does, just to so that we all know. Some of us have, of course, heard of you, but maybe many of the participants haven't. So that might give us a good starting point, and then we will get into some more questions on that.
Thanks so much, Shankar. And it's a pleasure being here. You started with a personal journey and, and how you sort of moved right up there with the MCA and with SEBI and all these amazing things that you're doing. My journey, unfortunately, is pretty much the opposite. While you go up the corporate ladder, I keep coming down. So started in Citibank with corporate bank, then investment bank, then mid-market, then SME, then HSBC with microfinance, now Grameen with rock bottom. So I've been coming right down the corporate ladder, unlike people like Arindam and you, and I'm sure Wei, who's been growing and going from one level of glory to the next. But it's been quite a fascinating journey. And when we started Grameen Capital, to answer your question, the dream was, how do we build? It was just after Professor Yunus had won the Nobel Peace Prize. And we were saying, what can we do in India? There are 400 million people, less than $2 a day. How do we help them to access, mainstream sources or formal sources of funding? And one thing we decided not to do was to start an MFI. The most sort of intuitive thing would have been to do and create an MFI because, that's what Grameen is known for globally. But Grameen Foundation, who was our founder shareholder, decided and, sort of did not resist my suggestion that we create an entity that actually works with about 100 NGOs that were already in existence at that time. Because we felt that if we have to reach 400 million people, it will take us more than a lifetime. But if we can do it with collaborators and partners and help them to scale, it would happen much quicker. So we actually worked with them, and at that time, even Bandhan was an NGO. So people like Bandhan, Jan Lakshmi, Ujjivan, Disha, so help them, many of them transition from NGO to for-profit to NBFC, NBFC to SFB or small finance banks. And of course, Bandhan became a mainstream bank. So that journey really was the journey from 2008 to 18 of helping to mainstream microfinance. In my role as the chair of Sadhan, when I finished my term 2 years ago, we had reached 52 million clients. So in some ways, if you take 6 members to a household, you're already 300 million people served. So to that extent, we said, how do we bring it to the mainstream? And you talked about, I like the words you used. I want to keep picking on some of the points you made in your opening comments. You talked about ESG as the new kid on the block. And in some ways, microfinance is the old kid on the block. And what I would like to do over the next, hour or so that we have is see the learnings that we have from the old kid on the block so that we don't end up reinventing the wheel, making the same mistakes, and can really build on some of the lessons that we have. And so in a way, I'll just sort of close with that and before we go into the next round. But we said, how can we bring those learnings to what we call the adjacent spaces? Because the same household needs affordable health, it needs affordable education, it needs clean water, it needs sanitation, it needs clean energy, it needs agri solutions. So we said, let's create Grameen Impact as an entity to work, because this was now becoming fashionably called impact investing. And it flopped. And the reason it flopped is that Grameen Capital was able to connect capital pools with the demand or from social enterprises. But in the case of these impact sectors, there were no capital pools at all. So as you talked about regulators, the priority sector definition sort of was the big plus that helped microfinance to scale up. Whereas we found banks who would rather do 500 crores to Bandhan than do 5 crores to 100 social enterprises. So that really was, how do we bring capital to the smaller social enterprises? And that created in us the clarity that, just building a social investment bank was good for microfinance, but that same model wouldn't work in the impact sector, in affordable health, education, water, sanitation, clean energy, and agri. So we said, so we talked to the social enterprises and they said, what we would really like is if you can do debt. Because equity, we can at least have reasonable visibility. People like Wei and IFC and, Avishkar and Lok and a lot of funds are providing equity to social enterprises in India. But debt is very constrained. And so we created Grameen Impact. We acquired an NBFC license and we began to lend to these social enterprises. And what we realized, and I'll sort of come back to a point where you talked about ESG at 30 trillion, it's exactly the same number when I was addressing the UN General Assembly, which is the gap in SDG financing. There is a global gap of $30 trillion. Now, how do we bring that type, and India probably needs 5 to 10 trillion of that global 30 trillion pot. So how do we bring mainstream capital to work in ESG? How do we bring it to work for the SDGs? In some ways, the ESG seems to be, and SDG seem to be two ways of looking at the same animal. The large funds, the BlackRocks and the KKRs and the Bains and the Goldmans put on an ESG lens and look at the large corporates. And people like Arindam and I put on an SDG lens and look at the smaller enterprises. And there's sort of, it's the same elephant, but just viewed with different perspectives. So I'll stop there.
Yeah, thank you, Royston. And we'll just come back to that, especially as you said, is it the same thing, just looked at differently with different letters? I think that's something that will be interesting to talk about. And by the way, I completely disagree with you about the way you describe the trajectory. It's completely the opposite of what you're saying. So please, we'll talk about that offline at some other point of time. Arindam, let me come to you, and again, welcome to this session. So I think it'll again be useful for all of us in the session to get a better hang of what you do at Rabobank. What is the kind of work that Rabobank does, which sort of which will provide the context for a little bit more conversation around the topic of ESG and its relevance to you. So if you could just start with that. Thank you.
Yeah, thanks, Shankar. Thanks to the Access team for inviting me to speak in this very interesting panel and panelists like Royston. So, Rabobank, it's a Dutch cooperative bank. It's the largest cooperative financial institution in the world. And interestingly, it's also the largest financial institution in the food and agri business space. But more importantly for this conversation, it is the world's #1 rated sustainability bank as rated by Sustainalytics. And I wear 2 hats, and one of the hats I wear is looking after all the sustainability-based businesses in this part of the world. And so the way I look at it, there are 4 legs. To put things in a very simple context, the first is knowledge. What exactly does sustainability mean? It's a tough question. It's a tough answer because it's a very evolving subject. Every day we are learning more as to what is sustainability, because there are many, many sectors. Now, what does sustainability mean in the sugar sector? What does it mean in the construction sector? What are the benchmarks out there? And from a banking perspective, what is sustainability banking? So these norms and benchmarks are evolving by the day. So first pillar is knowledge. The second and most important, and that was alluded to by you, Shankar, is about risk management. Now, it's important for anybody who provides capital to not only understand the financial risk, but also to understand the non-financial risk that the business is carrying. That is this business going to exist 10 years hence? That business may not exist because of regulatory risk, because the markets may reject this business, and there could be so many other risks, which is not covered in a typical financial risk analysis. So risk management is very, very important. And third, to take forward the point from Royston, that is sustainability financing a profitable business? Now, if we look at the global investor and we look at both the debt and equity providers, now it's still evolving, but the early data shows us that the sustainable companies which are rated and ranked very high are also the best performing companies so far as financial performance is concerned. So to some extent, this hypothesis that a sustainable company will outlast a non-sustainable company, or they would be there for a larger period of time and your capital would be protected, it's proving to be true. We still need more data on that. The third is about business development. So all financial institutions, they look for new avenues to invest in, and to invest in sustainability products. To sustainable business is big business out there. And the fourth, and very, very important, is about reporting. Unless you know what you're doing and you can report credibly to your internal and external stakeholders and be audited and held responsible, it doesn't mean anything. So the four legs I would say is knowledge, risk management, business development, and reporting. Now, why sustainability financing? Now, it's important that firstly, we all know that Mother Earth has its own limitation, that unless we do a business in a responsible manner, that we are going to leave behind a world which is going to be extremely difficult for our future generations. So that's one. But second is regulation, as we mentioned, is coming on very heavily on different kind of businesses, on different kind of financing across the world. And third is consumer preference and market preferences. If you look at any of the multinational companies which are reaching out to markets across the world, and if they touch on the European or US markets, they are perforce asked to report on ESG, SDG, or other sustainability parameters. That's because the investors there are extremely demanding, because in turn, their investors are asking tough questions of, is our money, which is being deployed through you, is it leading to any kind of negative consequences for society and for Mother Earth? So these are the tough questions which are being asked. And now it's being formalized through different kind of networks to define what sustainability, responsibility banking is. And it's growing, but I would still say that Europe and the US are far ahead of the Asia story and the India story as of now. I'll stop here for the time being, Shankar.
Yeah, thanks, Arvind. Well, perhaps we should come back to that as to why that is the case, why Europe and North America are ahead of the game. But I think that's a good segue into actually posing that question to Wei, to you, so one of the differences you mentioned that happens in Asia compared to the rest of the world is that here we look to the regulators to sort of push this agenda. And I'm just wondering what is whether there is some insights that you have based on your experience, especially in your conversations that you have in the sustainable banking network, as to why this is the case. What is the sort of trigger points for ESG thinking in Asia, and how do regulators, or how are regulators beginning to think about it, and how is it different from the rest of the world? So any insights on that would be very, very helpful. Thank you.
Thank you, Shankar. I think that's a really good question. I'm just thinking, we've developed, the SBN community has developed 2 global progress reports where we've been tracking, having one-to-one interviews with the regulators, with our members, banking associations, to understand the momentum driver for sustainable finance across different emerging markets. Well, one phenomenon, one data is that across a lot of the emerging markets, definitely in Asia, I'm more familiar with the East Asia market, Mongolia, China, Vietnam, Indonesia. These are the countries, when you look at the market, local banks actually provide bulk of the financing, meet the local financing needs. It's usually at the level of, in China, this is between 70 to 80% local financing needs is provided by the banks rather than the capital market. And then in Mongolia, this is as high as 90%, and also around 90% in Indonesia. So, across all those markets, it's usually with the banking sector that the sustainable banking started ahead of overall sustainable finance. Where in European, definitely is, Andrew can share more on that. It's an institutional investors market, where you usually start from a capital market perspective for ESG integration. Well, in those East Asian countries where we've been working closely with, it starts with the banking industry. And then banking is a heavily regulated industry, as you know. This is where the banking regulators have a strong influence on everything. I think that partly explains why we're seeing a regulatory-led approach. My team is actually more focused on the risk perspective. When we talk about sustainable finance, when we develop the report, we have put the whole analysis into 2 lenses. One on the risk side, one on opportunity side. So for risk side, you basically put managing of environmental and social risks. Environmental risk range from pollution issues. I mean, these are the sub-project, project level risks, but they can be passed on to investors into the local financial institutions and of course for the financial institutions themselves. So, and then on the opportunity side, these are lending green finance, lending to renewables, lending to also meet increasingly some of the social needs. So we see this in two lenses for the bank's operation: risk, this is medium and back office operations, and then for the lending side, that's the front office operations. So from a risk perspective, we're also seeing a strong push from the regulators. So this is usually what the country is on two fronts. On the pollution side, accelerating, intensifying its environmental overall enforcement. Then that creates a driver for financial institutions to wanting to protect its portfolio. And then increasingly, after the Paris Agreement, climate risk kicks in. There's a lot of climate-related considerations. I wouldn't elaborate on that. There's a lot of discussions on that front. So, I mean, just to summarize, you can see a strong regulation-linked push, and then fundamentally it's linked to the local financial market composition, where it's a banking-heavy financial markets.
Okay, but I think what you're also saying, which is very interesting, is that it's banking led, and banks are the very heavily regulated. So there is that element of regulation. But what you're also saying is the regulation that is pushing the borrowers themselves, which then has an impact on the lenders to also look at these kinds of issues. So whether it's pollution related regulations on companies that are doing whatever they are. And so the banks are then have to look at that as a risk into the way they themselves do the lending. Yeah, so it's on multiple fronts that regulation plays a role. And that's an interesting insight. I was just wondering, just if I can just stay with you for another short question, which is again on the SPN. What kinds of conversations happen on ESG? I mean, is it something which is a sort of a sidebar, or is it something more core? Is it becoming more core as a conversation in your meetings and interactions?
It's that's an evolving kind of agenda. When the network was first formed in 2012, the focus of the discussion is pretty much on traditional environmental risk management for banks. That's when sustainable finance was pretty new concept for most emerging market countries. So at that stage, we've been working at the time with regulators in most East Asian countries, Mongolia, China, Indonesia, Vietnam, and the Philippines. These are the 5 countries that IFC started to work at the country level. The discussion at the time was different regulators have different approach, but overall they want banks to start to understand environmental social issues and how this can potentially affect their portfolio. From a risk management perspective, you can see the regulator usually come in with a risk management perspective, wanting to protect the overall financial market resilience and protect the bank's overall portfolio, making sure it's a sound portfolio, healthy portfolio. And then they don't want to rush the agenda at a time. So it's more focused on banks having systems, banks having strategy, overall overarching. So board is aware of the importance of this issue, and the senior management started to be asking questions for their portfolio officer, for their credit officer to look into those issues. So it's more like a corporate governance structure change for ESG integration in that. And then gradually, they feel more comfortable with this, and they feel the banks are building up their procedures and process. They start to put in place reporting requirements. These are sustainability performance reporting requirements. Indonesia is a good example. Their financial market regulator put in a guideline for sustainability reporting requirements for all financial institutions beyond banks, because OJK's kind of regular scope of coverage is beyond banking industry. So it also covers capital market and pension fund and the insurance industry. And then gradually start to move to include a more incentive, encouraging financial innovation, lending to renewables, lending to small mini hydro projects. And so this kind of innovation side, but this is usually not done through guidelines because, I mean, regulators just want to send signals. So these are the potential sector you should be looking into. And recently, it started to shift more towards climate risk consideration. But this is definitely very new. I'm sure you have all heard of the NGFS, the Network for Greening the Financial System. This is led by the French Central Bank, and also now is a kind of a growing network for central bankers. The focus is very much on environmental risk, but focus on climate risk consideration from a central bank perspective. So this is a good, if you look over the past 8 to 9 years, is really evolving priorities for the regulators.
Okay, interesting. Yeah, so it is a journey, and I guess I know it'll be interesting to hear from both Royston and Arindam how you see that playing out in India. But we'll come to that. Royston, I want to come to you, and interesting that you said that ESG and SDG are basically two sides of the same coin, which they are indeed. At the end of the day, I think the financial institution, the financial sector likes to, like any other sector, likes to create its own jargon. So ESG is that kind of jargon. But I just wanted to know how it plays out. And it is interesting when we heard from V about the focus on environment that was there in East Asia. And a lot of what you do in Grameen, I guess, focuses on the more on the S part than on the E part, because that's the nature of what you do. But I'm just wondering, how does this play out? How do SDGs sort of inform the way you go about doing what you do? And how do you sort of look at E and S and G in the context of your work and linking that up with SDGs?
So we started by saying ESG and SDG look similar, and then Arindam threw a new word in the mix called sustainability financing, which again is similar. And we talked about the greening of the financial system. So it's true that each one's sort of coming at it like the different men who looked at the elephant. But I think it's important for us to recognize the elephant in the room and outside, but more importantly, to make sure that each one's doing the segment that we're looking at with sort of impeccable focus. Last night, I was on a call with Nick Donahoe on what they call just transition. Now, just transition is going to lead about $2 billion of investing from the CB. We are all talking the same thing. It's just that, and I remember this because I don't know if you know Pierre Gramigné, who was the finance minister for Luxembourg. And he was, he invited me to speak at the Sustainability Finance Forum as a keynote speaker. And they had listed, I think, a $500 million green bond on the green exchange. And, I told him it's a bit embarrassing because, you're talking about $500 million of investing on a bond. And here we are doing a $500,000 bond, so putting me up there. And, he reminded me, he said that, many years ago, 30 years ago, Professor Yunus came up with a loan, but with many zeros removed, and called it a micro loan. And what you're doing effectively is doing a bond, but many zeros removed and doing a micro bond. And therefore, it sort of got me thinking that I don't need to do a $100 million bond or a $500 million bond. I would be happier doing $1 million bond and 500 of them. And therefore, that's where Arindam comes in to support me as a banker, and Way comes in to support me as a equity investor in my NBFC. I'm doing a subtle pitch to both of you. But the fact is that that's exactly what we want to build. We want to build an SDG bond engine where we are creating micro bonds for an entity that's doing solar panels, an entity that's doing plastic collection, an entity that's doing livelihood training, an entity that's doing agri-tech. And we've done that. So literally what we did was in 2018 at the General Assembly, people were talking, really large numbers and big ways to approach SDG and ESG and talking about impact bonds. And each of these bonds were taking 2 to 3 years to get done. And I said, why not challenge this hypothesis and say, can we do it in 2 to 3 months rather than 2 to 3 years? what is taking time? And what was taking time is just an inefficient process, because we were looking for an impact investor, then an implementing partner, then an outcome funder, then an evaluating agency. And when you found one, the other one escaped. When you went searching for that one, this first one ran off. So that process was making the middleman rich and the lawyers rich, because they kept rewriting, the bond MOUs. But what was ending up in terms of money coming in as outcome funding was getting lost along the way. And so we said, let's create micro bonds and do it in 3 months. And literally, Shankar, from September 2018, every 3 months we've done an impact bond. We did the first one on Goal 5 on women's empowerment with 2,000 tribal women in rural Madhya Pradesh to become poultry farmers. Small $1 million bond, got that done. And we define the outcomes when we give the money. And through the life of the bond, 18 months, 24 months, and that's where I need your help in the Ministry of Corporate Affairs. Because in that process, we want to say, who is interested? Which CSR is interested in 2,000 women becoming empowered? So Johnson & Johnson, Unilever say, yes, that's something that I want to do anyway. So then if these 2,000 are trained, would you then pay the coupon for those social enterprises? So they get an effective 0 coupon bond. Or in 3 months from there, we did a Goal 8 bond on livelihoods and skilling for 20,000 youths to be trained and skilled. 3 months from then, we did a Goal 5 and 8 combination to make women weavers, creating their own line of rugs and dharis and carpets. We then did another bond on Goal 7, and where you'll be interested in this on solar energy and renewable energy, for companies to drop the cost of the energy through an impact bond. And then we did one on a COVID impact bond for women livelihoods, so that we could repurpose the skills of artisans to be able to make masks and sanitizers. And now, with Arindam's blessings and good wishes, we are working on a Goal 2 agri bond, where we're working with agri-tech companies in the cold chain, in the distribution, in the technology solutions to be able to pivot. So that's really what we want to do. Right now we're doing it off our balance sheet, to your point, Shankar, in terms of how do we scale this. And so it's $1 million each. But next year I want to do 10x of each one of them, because in India, the good thing is we always have enough of scale available to us. So that's when I will bring in co-investors to invest, and it then becomes a bond really in its truest sense. Right now, it's more a loan. But year 3, again, Shankar, is where I'm going to draw from your expertise and connections, is where, and we're working with Madam Sitaraman on the Social Stock Exchange. Year 3, we want to do 100x. And so we want to list those $100 million bonds on the Social Stock Exchange. And that's when we want to democratize funding access. So the path is very clear in my mind, but my mind is not, is not the way it should end. We need to be able to bring this to market. We need to be able to create those products. We need to be able to catalyze capital. And that's where, the traction from many people come in. So it doesn't really matter, are you looking at an ESG lens or an SDG lens or a sustainable finance lens? Because on these 17 goals, everything is there. Within each 17 goals, there are 169 indicators if you add them up. Each of these indicators can be outcomes. So we are able to distill in a very clear manner, and corporates are excited about these goals. Governments are excited about these goals. So why are we creating new taxonomy for everything? Why are we reinventing the wheel for everything? Why does RBI have a list of priority sector lending, which is different from SEBI's social venture capital fund definition, which is different from MCA's rules under Section 135, which is different from, everyone's creating their own list. When do we stop I'm going to go blue in my face trying to say this at every place? Let's build one set, probably something that 193 countries have signed up on, and then make this your list of PSL for RBI, and make this your list for CSR, and make this your list for SVCF and SEBI, so that we're all talking of the same script and singing of the same music sheet. I'll stop there.
Yeah, but I think the good news is that I think the music that you've been singing and playing is being heard, because certainly I can say for the national guidelines, when we were putting it together, we were very much looking at alignment with the SDGs. And so the BRSR was aligned with the SDGs. So I think so SDGs in that sense becomes a very interesting central framework around which we play this. But just to sort of take it a bit one step forward in terms of what you said, deployment of the funds that you get. So am I am I right in hearing you say that the outcomes that you're asking from your borrowers or your investees is sort of defined in SDG terms? Is that the way you ask them to, or you at least report on the outcomes that you're trying to seek from them?
So we ask them for outcomes that are germane to their business. So for example, if I'm looking at a dairy company, then I will talk about the number of dairy farmers. I will talk about the productivity. I will talk about the milk percentage saved. If I'm looking at plastics, then I will look at plastic tonnage collection or waste reduction and CO2 emission reduction. If I'm looking at vocation skilling, I'm looking at number of hours trained, number of placements, number of months on the job before counting it as a successful placement. So we don't want to complicate that. That's one thing Grameen has learned in microfinance. You can't complicate the life of the end borrower. They have to do what they do and they do it well. So we then, reclassify them, and Arindam and I and his team in Netherlands would categorize it and say, how do these really fit? What are the learnings? Where do these fit in within the SDGs? Is it 7? Is it 13? Is it 12? And we do all of that and then talk to the CSR. And that's where, I think is a critical link that is missing. Because if a CSR today invests in a for-profit company, they don't get the benefit. But my point is that if I'm able to do an agri-bond with Arindam and the farmer productivity goes up, why should Nestle or Kellogg or Unilever not say that coupon I'm ready to pay, because I'm really incentivizing the farmers to become more productive? Or why should J&J not pay if I'm able to do women's empowerment and train them? So that, I think, is the critical piece. Why I'm not trying to eat or swallow into an NGO pie. And we're happy to, we've done half of our bonds with NGOs, but we are the first in the world to start impact bonds with for-profit companies. And it's not easy because it's not apples to apples. They are not able to get the money directly and it's complicated. But it's such a simple process if we are able to declutter the regulatory paradigm.
Right. Thanks, Royston. Arindam, let me come to you. And your name was mentioned a lot by Royston, so maybe you want to join those dots for us also. But just to also talk about your work in Rabobank, and again, just trying to understand how you look at the ESG stroke SDG sort of lens in the way you go about the work that you do at Rabobank. How do the two get integrated in thinking and on the field?
So Shankar, to put it bluntly, we don't have a choice. I mean, from a risk perspective, unless we do a deep dive on the sustainability, that's the non-financial risk, the proposal is not going to get approved in the system. So how do we do it? And the crux is that it's not about understanding the business that you finance, but it's understanding the entire supply chain to see the impact that your money has on the supply chain. So for us, just to tell you what the process is, and I'm sure all banks will have to do it someday or the other, before every origination, and I repeat, every origination for every retail or corporate loan across the world, we do an exercise, or we undertake an exercise. It's called the client photo exercise. Now, what is the client photo exercise? It's an exercise by which we rate and rank that particular business on sustainability parameters, on ESG parameters. There are 20 questions, 20 topics divided into 40 questions, and each one has got a certain rating, and we come up with a rating for the potential of future borrower. Now, if it falls below a certain threshold level, irrespective of the strength of the balance sheet, we cannot do business with them. We can make an exception where they have a very strong sustainability plan to improve on the sustainability footprint. Exceptions can be made, but they are hard covenants put in for them to improve their sustainability footprint. So it allows us, all our frontline relationship managers, firstly, to imbibe the knowledge of sustainability. When they deal with clients, they have to ask those questions, get answers. Those answers have to be vetted by the risk team. The final rating is also vetted independently. And overall, at the portfolio level, because of all the granular rating and rankings we have, a portfolio gets a rating and ranking. And year on year, There are KPIs set on how we can improve the portfolio rating. There are all kind of targets which are set there. So we don't have a choice. Now, it's because of the very firm risk management parameters which have been put in place to understand and to manage sustainability risk. Now, one of the things you dealt with are the E, S, and G part of ESG. Now, I would say, and I will stick my neck out, and I would say that at times I'm in a very tough position working for a European bank in Asia because they are in some ways two different worlds. So in Europe, the E part is getting extremely critical, and they are looking at it with magnifying lenses as to what is the impact that our business, our loans are making on the environment. In India, and what has come out strongly from even what Royston has said, the S part, the inclusion part, whether it's among the worker community, it's among the people who are borrowing and all, how do we ensure access to finance? It's just because that in the journey, in the economic growth journey, parts of Asia are at a different level than most of Europe. So for us, the immediate priority is on the S part of ESG. Even if you look at most of the government circulars and the maze that Royston referred to, the priority sector norms and all, it's all about inclusion. And India, rates and very strongly on inclusion parameters so far as its business or its financial institutions are concerned. You talk to any business and you ask them, how are you impacting society? Then the first thing they'll talk about is the S part of business. Look, this is how we treat our workers. This is the gender balance. This is the kind of facilities we are providing. And for our customers, we are providing, bespoke products and solutions to the poor. That's how they see CSR or sustainable business. But you go to a European corporate, they will immediately talk about the climate piece, the environment piece. So there is a difference there so far as prioritizing between E and S is concerned. But then I do not see any contradiction there because it all depends on what is the requirement for a particular business in a particular geography, because we will have to focus on both to make it an equitable world. We don't have a choice.
Right. And I think I completely agree. What you're saying is that the balance has to be contextual, but it's not that one can be ignored. We need to look at it holistically. And I think part of, to me, the nice thing, and I use sustainability, my preferred expression is sustainability because that gives it a more holistic picture. ESG somehow suggests that they actually can be seen separately. They actually cannot. They are so indivisible that they need to be seen together. So
these are frameworks. Sorry.
Frameworks, yeah, correct. Thank you. Shreya, you have some questions for us from the participants that you could put forth. Yeah, yes, please go ahead. Why don't we take some comments and inputs from the participants and to our panelists. So would you like to also indicate who you would suggest respond? They respond or would?
Sure.
Yeah.
So I have a question for Wei from Namit from World Benchmarking Alliance. The question is that climate continues to be a dominant focus on ESG in the work that you mentioned, and the S of ESG appears to be lagging. Why do you think this is the case, and do you expect it to change anytime soon in Asia? This question is for Wei.
Wei, before you respond, do you have any, maybe you can just put a question each to all our panelists.
Sure.
And then
no problem. I'll do that. So there's one question directly for you, Shankar, in which the participant is asking what is
I don't think you should be. I don't think I should be answering any questions. We should leave that to the panelists. But first, why don't you put the panelists' questions, and then I'll take.
Sure.
I'll take
Don't fall for his. Don't let him have it.
Sure. So one question that we have is, what kind of ecosystem would Asian countries need before ESG becomes a central theme of investment? And this question is essentially for you, Royston, and for Arindam. And weighing in the context that what do you think the ESG aspect would be more applicable in India in the regulatory space when you see that India finally starts reporting on the SBN framework? The example given is that we have the social stock exchange, which is coming in, and it also follows some ESG principles at that. So what exactly do you think would be needed to set the stage for ESG in India? So yeah, so these are one direct question to Wei, and then for the rest of the panel.
Okay, great. Thank you. Thank you. Wei, would you like to go respond to that?
Thank you, Shreya. Just to make sure I get the question right, I think you said the first question is climate change remain to be a focus for SBN. So why is social missing? Is that the question?
Yes, please.
Yeah. Okay. Yes. Yeah. I think that's a very good question. I mean, also interesting. I mean, climate continues to be a priority because a couple of reasons. First is climate finance does offer new business opportunities. I'll be speaking largely from a banking perspective. So commercial banks are quite keen. This is offering new market opportunities, new business development tools for them. So you see a lot of interest on that front. And again, with the green bond market developing, that's additional business opportunity, funding sources. So there's a lot of interest to understand more on the opportunity side from the banking industry. On the risk side, the push is largely, or driver is largely from the central banks. I think in this regard, again, we're seeing, especially with the NGFS network, this is in the initial day. I mean, in the earlier years, there were a lot of deliberation on the why should central banks get involved in this at all? Should central bank stay with the prudential kind of traditional central bank's role, or should central bank step into this climate change role at all? But now, this year, definitely we're behind that discussion. So it's really moving into the how. So that's where you see SBN and the World Bank Group overall are also observer on NGFS. So we're staying really close. Our focus is more making sure any knowledge from this largely European central bank network is passed on to the emerging market players. So emerging market stays relevant in this discussion and making sure the knowledge is spread, and also empower the emerging market central banks to be able to work also in the climate risk space. But what is being done is largely portfolio stress testing using the climate change indicators. This is very new. I mean, largely still UK, Bank of England was able to do that with the insurance market. I think the Dutch central bank also is doing some stress testing for their own portfolio. But emerging markets are still learning. We're seeing a lot of interest to understand more on this. So, and then why is social missing? I think that comes back to one of the questions, Shankar, you mentioned at the to start this panel, a business case. When I'm talking about social, I'm talking it more from a risk management perspective, not from the business opportunity. I think that's Royster, your role. On the social investing, more kind of using social as an opportunity to invest. On risk management perspective, we're seeing challenges for commercial banks to see social as a risk factor for their lending operations. Linking to Andren's earlier comments, all the multilaterals or most developed market banks will have ESG standards, meaning when you're lending to a corporate borrower, you'll be looking at their environmental practices, you'll be looking at their kind of labor practices, but across a lot of the emerging market, this is not the case. Banks don't look at their corporate borrowers' labor practices. Banks don't usually do human rights due diligence. This is a new concept, and they don't see a business case for that. So you could be lending to a corporate borrower that's violating basic labor laws, but the corporate borrower is paying their kind of paying back on time, they still consider good client. So the business case is not there yet. And then this again links back to an earlier discussion, Shankar, you mentioned. If in a certain country, the social labor law enforcement is not there, that means the banks don't see that as a risk. So it's a kind of an interlinked cycle that you can't just have financial institutions uphold ESG standards while the labor law violation is not published by the labor administration. So where the market is doing successfully in certain aspects, especially on the environmental pollution control side, is where we see a cross-ministry, cross-agency collaboration between the financial market regulator and the environmental regulator. Well, on the social space, this is missing.
Thank you. Rostin, would you like to go?
So I would,
any of the questions?
No, I would say, and I want to come to the point Wei made as well, and the question on S. I think it's a matter of size. It's easy for large corporates, for IFCs, for multilaterals to deal with large numbers. That's the way they're designed, and therefore it's very tedious to look at really the granular, smaller effects. So you can do a large, clean energy plant. You can do a large wind farm, and these are easy to dimension risk. But to do thousands of small social enterprises is a challenge. So which is why we need an intermediary ecosystem, which is, I'm moving to the next question. What is the ecosystem gap that exists? And the gap in the ecosystem that exists is to create an aggregating entity. And I see Grameen Impact as being one of those aggregating entities. That if an IFC says, I'm ready to invest $15 million, then I can disaggregate those and give it to social enterprises, much the same way as IFC invested in Bandhan Bank, and they disaggregated it manifold and had millions of micro borrowers. We need to reimagine the way we're looking at ESG financing. And therefore, the investor emotion, Shankar, that you talked about when you started about fear and greed are pretty much exactly the opposite when you look at SDG financing. It is about not negative emotions, but positive emotions. So how do we channel positive emotions and make that capital available to social enterprises? And which is where the point that was raised of the social stock exchange, or even Shankar, and I don't know how your good offices can push this faster, but creating even escrow accounts where CSR can be parked to become outcome funders. So that at least, those get treated as CSR, and when outcomes are met, then they can be paid out of those escrow accounts. So that we're not waiting till 29th of March to know whether this will work or not and then put money out. But that's a big pressure on CSR if they don't know if the outcome is going to be met or not. So we've been innovating and trying to make suggestions, but there has to be a policy push. And I think that is critical to the question on what Shreya asked about ecosystem. If the ecosystem needs to really now come together and support ESG and SDG financing, there has to be a congruent catalytic policy that's in place.
Thanks, Royston. Anandam?
Well, the only point, I think we have a couple of minutes left. The only point I have to add is, look, the S part, it's easier to monitor, it's easier to measure. Now, the E part is more complex, that we are still in the process of learning that how do we measure the impact on environment, or for that matter, the climate risk. Now, a lot of work is being done on that. And it's extremely important in our context in India because we are in the red zone, so far as water risk is concerned. Now, weather risk is a big risk for India's agriculture, right? So what I would urge is that environment risk and climate risk gets integrated into a financing process, if needed through regulation, as quickly as possible. But as Wei mentioned, that initially it's important to ensure that the financial institutions, especially the mainstream banks, it's also the same story here. Most of the financing happens from mainstream banks in India, right? The Indian large banks, that they have the wherewithal to firstly be able to understand the impact their financing is making on the environment and the climate, right? And it's a process, it will take its own time to mature. Once that's in place, regulations need to be in place. Otherwise, we are going to look at a disaster.
I think the important, the question always is, which comes first? Does regulation come first or does behavioral change come first? And I think,
ideally behavioral change, but when it doesn't happen, you have to force regulation. We have seen it across the world. Ideally, it's the consumer demand. It's the markets which should change businesses for the better. But at times, I guess we just don't have the luxury to wait for that.
Yeah. No, I think that's one of the market failures, right? Because I think, for example, certainly in India, I don't think markets, consumer pressure, at least retail consumer pressure doesn't push the needle. Business, B2B businesses, it perhaps, but not
absolutely
otherwise.
Not retail business.
Yeah. Shreya, do you have any more questions that we could take from the participants before we continue?
No, so these were the questions that came to the participants. I think we can continue, Shankar. Sure.
Okay, thanks. So, I just want to come back to you again, talking regulations, because that's clearly, a driver, and it is indeed a driver, as you said, in most of Asia. It's certainly a big driver in India. And although we can debate on which, ideally, the regulation should be lagging, but, it doesn't necessarily do that. And I think, I just also want to link this up with the point Royston made about multiple taxonomies. I think one of the questions that we all often have to deal with, and that has to be dealt with, is the whole taxonomy around what is sustainable finance, right? Because, it's necessary, of course, when you're going to, when you're doing a green bond or whatever, but even otherwise, even just from a reporting perspective, it is good to have some sort of a sense of what constitutes sustainable, because I think Arindam made the point that this is one of the things that is constantly evolving. And taxonomies also need to evolve. They can't be static. But I just wanted to get your sense on what has been the thinking in the Asian region on taxonomies around sustainability, around ESG, and where do you think that is sort of moving?
I think taxonomy is really a big topic, a heated topic. At least we can see from SBM perspective, and a lot of the members are quite interested in this idea. When we're talking about taxonomy, I think people sometimes will be talking about different things. For a lot of the taxonomy so far, as we see it within the SBN community, is really the green finance taxonomy. So, and then there are, in this space, there's a lot of progress and there's more clarity given some of the international organizations' work. Notably, I think two leading players is the CBI, the Climate Bond Initiative, because if you look at the GBP, the green bond principle is more principle-based approach, while the CBI does have a taxonomy, kind of a detailed list of eligible activities that you can classify as for climate bond eligible activities. So it's more prescriptive approach. And then there was for some time there was a debate if it should be a principle-based approach versus a prescriptive approach. What we're seeing is there is quite a lot of interest for a more mature capital market in developed market. It seems people prefer a principle-based approach where you have other infrastructure of the capital market in place, verifications, and kind of a market is functioning properly. Where we do see a strong interest for a prescriptive approach across emerging market, where the capital market is relatively less developed, the infrastructure is not there, and regulators are more interested in having a list of eligible activities prescribed for banks So these are the green loans. You shouldn't be adding other types of loans, call it a green loan, to avoid greenwashing. I think this is for the green finance space. And now there's more progress to clarify some of the activities may be eligible as specifically climate finance. But and then some are beyond climate finance. You have different kind of circles. It's not contributing to climate change, but that does have other environmental benefits where you can call green finance. And then the further milestone is really the EU taxonomy for sustainable activities, which expand that whole discussion. And that's based on multiple years of technical expert input. I think that brings further clarity, and also is being used as an international benchmark in developing national sustainable finance taxonomies.
Yeah, I think, in some senses, the EU taxonomy is beginning to become the gold standard because there is a need for a global, it'll be absolutely chaotic if each country or each region comes up with its own taxonomy. But yeah, we got to, I guess we're all watching that space. But I just want to come to you, Royston, on this, starting with this taxonomy question, because you brought that up early, and just wondering what your thoughts are on that. But I also wanted you to speak to your earlier life, your Citibank days, and when you were doing a lot more of SME, working the SME space, because that's an area where this whole ESG agenda is actually very challenging, especially because the sort of business case is less evident, and SMEs struggle to survive, and then for them to absorb the whole idea of ESG becomes even more complex. So I'm just wondering, where do you see the light at the end of that tunnel in the SME space for ESGs? But first, just a bit on the taxonomy before you get there. Thanks.
So on the taxonomy, I am one who just hates hair splitting and definitions and spending hours in 5-star conferences discussing definitions. So for me, it really doesn't matter. My point is, whatever is decided, everyone should accept across. So the RBI list of a private sector, the SEBI list, CSR list, just let's clean it up. Let's just agree on one set and then everyone agree on it. Because, and then let's focus on getting the work done. Which brings me back to the question you asked. Why can't we incentivize and make it exciting for an SME to want to do something in ESG? And the reason is, if we can turn it on its head and say, because if CDC is talking $2 billion and IFC may be talking similar amounts and World Bank's talking even more, to be able to drive this just transition, why can't we make that money incentivize the SME and say, listen, if you're doing this, instead of paying 16% interest, you're paying 6%. Who will not jump? So we need to, rather than force them, no, you need to report it, do this practice, say, no, you do what you're doing. But if you can do it differently and cleaner and greener and more inclusive, then hey, your cost drops by 10%. And that someone is ready to pay for. CSR is ready to pay for, but it has to be kosher that they can pay to a for-profit company. Or HNIs or philanthropists or donor agencies are ready to pay for, but it has to be correctly packaged, measured, and implemented. So that really is the key. Why should an SME not benefit from a guarantee from Rabo Foundation or from FMO or from DIG or KFW if they can show that this is what they're doing on ESG or on SDG, and that guarantee drops their cost of funds or gives them an outcome funding out. So I think it needs simple creativity. It's not some complicated structuring. They need to know that my life can become easier, my cost of funds can become cheaper, my products can have a wider reach if I do these 4 or 5 small tweaks. And we need to take the headache, as in my earlier life of Citibanker or HSBC or Arindam in his bank, and translate it into language that the big multilaterals and the policymakers can understand. So that's why my hair became gray. I mean, it's not about a wisdom that you have, Shankar, which made it gray. It's about banging my head against the wall, trying to get people to appreciate how we can, turn it on its head and say, incentivize the impact. I think that's the bottom line in our SDG impact bonds. Someone has to incentivize that impact because someone else is motivated by that as well. If girls are in school, someone else should be excited about it. If mothers or women are entering the agricultural workforce, Rabo Foundation should be excited about it. If someone is reducing carbon and cutting down wood, IFC should be interested in it. And they are, but they just don't know how to translate it to that poor woman who's sitting in a forest and cutting down trees. And we are able to do that translation. So someone has to be able to do that translation, aggregation, and becomes a $500 million bond. But that aggregation is critical.
Yeah. So I think, the incentives often end up being perverse. And I mean, I often have this conversation with when I'm in an Adivasi, in a tribal area, and, they are the guys who protect the forest, but they get absolutely nothing for it. They're the ones who are going to help us get to our NDC of how much we are able to.
I must say something here. My next call is with the newest. It's a new post. It's a Minister for Climate Change in Argentina. They've created a new ministry, and he's talking about doing a South-South bond with us, where we can look at the Amazon part of the forest that comes under the Misiones province in Argentina and say, how can communities working in forests, exactly to your point that you mentioned, Shankar, about tribals who are, contributing so much to greening our world, and say, how can they be incentivized and livelihoods get generated in a sustainable fashion for them? So we're trying to see, can the tribals of India and the tribals of Argentina and the Maori tribes of New Zealand and Nigeria come together in a South-South bond. It's crazy, but we don't know, but excited.
Yeah, but just on there as an aside, you should get in touch with the Tata Steel guys. They run a program with tribal communities globally, and all the tribes you named were often part of that. They didn't have it this year, but in 2019 I was there, and you had tribes from the Amazon and you had some Maoris and Masais and everything else. So,
wow, thank you.
You should have a conversation with them. Arundam, coming to you, and again, I just want to, just like I did with Royston, want to go back to your earlier life in NABARD, because I think Royston obviously has a lot of dealings on priority sector lending, and NABARD was principally at the center of priority sector lending, at least in terms of what one does. And I think it also feeds into this whole conversation that we've been having about regulation and regulators. So I'm just wondering, how do you see all these things coming together, and in terms of the role of the regulator? So, we talked about how regulation in a lot of the Asian countries evolves, and the starting points are different. We talked about, taxonomy and what constitutes priority sector lending, the complications of rural lending and agribusinesses, which is central to what you do, and how does regulation or how does the regulatory framework play there? Because all of them in some ways are linked with not so much with a G, but certainly with an E and an S going forward. So I'm just wondering, do all these things sort of fit in together, or are they just a very complex system and we just need to deal with them separately?
Well, that's a tough question to answer, but I think it's complex. It's a complex maze out there, as Royston keeps saying. It is complex, but having said that, let's give credit where it's due. Let's talk about the PSL norms. Now, priority sector, the way the RBI master circular on PSL year on year keeps getting modified. Now, I can say with full confidence, had the PSL norms not been there, mainstream banks would have shied away from farmer financing. Today, you have billions and billions of dollars of smallholder farmer financing portfolio with the mainstream Indian bank, the private sector bank. It's billions of dollars of funding. Had PSL not been there, they would not have done this kind of lending. They would have perceived it to be too risky. But now, because the regulatory framework is there, and there are penalties for not abiding by the PSL norm, that they have figured out a way to manage this portfolio from the origination, monitoring, or from the collection perspective to make it a profitable portfolio, right? They have put in their effort, but they have managed that. So let's give credit to the regulator. Otherwise, the smallholder farmers would have never got financing in India. Huh? So it has its advantages, but again, it's a maze out there because, if you want to do different kind of structuring in India, the biggest bottleneck is, Royston keeps talking about it, we keep talking about it, that what's popularly known as blended finance solution, which is required for, ESG financing or niche climate financing, where you mix non-commercial capital and commercial capital together. In India, because of separate regulations, whether it's RBI, Home Ministry, HCRA, income tax, SEBI, you name it, you simply cannot mingle commercial money with non-commercial money onshore. All these so-called blended finance solutions, they need to be done offshore. So it's a maze. If somebody tries, it's not that people have not attempted. Many development financial institutions have attempted to bring in soft money into India to provide low-cost solutions or provide high-risk taking financial solutions for nascent sectors which are perceived to be more risky, but they have not been able to. So there is a regulatory maze out there which needs to be sorted out to enable more innovation so far as financial structures are concerned. And as Royston says, there are billions of dollars of non-commercial money globally which would love to invest in India in health, education, agriculture, if given the opportunity to do it in a manner which is scalable, which makes sense, and which is measurable. Huh?
Yeah, thanks, Arundam. I think we are sort of coming to the end, and I'm just going to look at Shreya to ask whether there are any more questions that we have from the participants before we start closing the session.
No, not really. I think those were the questions that we received at that time.
Right. Thanks, Shreya. So I think as we move to closure, so I think what is emerging is that, yeah, am I audible now?
Yeah.
Can you hear me? Yeah. So as we sort of come to a closure, we have a few minutes left. I just thought that we should we understand that that regulation is a big factor, and I think we started with that, and those were pretty much in the PSL context. Also, what you said. But having said that, there is a lot of space in between where market forces in some senses can also play a role in pushing this agenda. But let's come to the question that we are all trying to sort of respond to. I think we've all identified a set of factors out there which makes the case for why investors need to, in their investments or lenders in the way they lend, cannot anymore ignore the ESG factors in the way they do that. So it seems to be almost self-evident, but I'm just wondering whether if we could just go to each one of you and just, if you were to convince any of your people you meet or members in your network from the financial sector as to why should I even bother with ESG? What would be the arguments you think that you would make to say that it absolutely is something that makes sense? So I would sort of put that question to you. In other words, what is the business case for a financial institution to worry about this? Not your financial institution, because you have the answers to that. But I'm just saying in general, suppose you were to go out to someone else other than in the same choir, what would be the sort of argument for that? So I'm just wondering whether we could start with you, where what would be the arguments or what would be the business case that you would articulate?
Yeah, Shankar, I used to do that a lot in the earlier days, especially in China, where we do a lot of like supporting and advising IFC investee banks to up the game on ESG side. But I don't need to do that any longer because the regulator has put in regulations. So that's regulatory requirement now. But recalling that, I think a case study could be really powerful. When we were trying to convince a bank's board to adopt the equator principles, you may have heard this. This is kind of the international kind of golden standards for environmental and social risk management. So the board was asking the same question. It just convinced me, why do I need to do this? This is going to involve cost for us, and I don't see immediate benefit. This is not something like by doing environmental social risk management, you are bringing me additional business. It seems I just need to do more checks. I need to do more screening. So we kind of convinced the board by saying, yes, you're right. There is a cost factor to be involved, but you probably need to do it. If you don't do it this year, in the next 5 or 10 years, you need to do it. The trend is there. This is going to link back to the SDG, link back to the Paris Agreement, climate change. We all know the broader agenda is there. It's a matter of time. If you do it now, you can stay ahead of the game. You can increase your competitiveness, and then you can start to protect your portfolio on risk side. So I think, and then you can actually calculate how much cost is involved. So for you to make an informed decision. So, and just cut it short, that bank we convinced became the leading green bank in China. And they did use the green banking as a strong competitive edge for all their business decisions. They got most of the first deal on green financing in China because of they stayed ahead of the game.
Great. Thanks, Lee. That is a very good example of how one should go about doing it. Certainly a lot of lessons for me there. Royston?
I mean, I've been thinking of the earlier definition of the business of business is business and profit maximization and all leading economic theory. And yet on 19th August 2019, 181 CEOs in the Business Roundtable said, while each of our companies serves its own corporate purpose, we share a fundamental commitment to all stakeholders and redefine purpose in a sense. So, I don't think people now need to be convinced because the billions of dollars are clearly getting, and Larry Fink's letter to, his New Year letter also talked about similar lines. I think what is important is, again, to push the agenda that we can't just touch one part of the elephant and look at only the big projects, because big change will not happen just with big companies. And I think the point you asked on SMEs is absolutely critical. If 80% of our economy and of our workforce is in SMEs, then how do we really energize them to be part of that ESG or SDG or just transition journey? And that, I think, is the critical piece that we need to move forward to. So therefore, the definition that you started your opening introduction with, Shankar, on investor emotions and the negative emotions, I think we need to change the script there and say there needs to be a focus on positive emotions to invest. And those have to be changed for good, and that will help us to build back better, cleaner, greener, and more inclusive.
Right. Thank you. Thank you, Royston. Arinder?
Well, my short answer would be more blunt. I mean, if I find a financial institution which is not looking at its investments from a ESG or a sustainability lens, I'll say that you are a business organization which looks at quarter-on-quarter profit. Have you ever thought that whether you will survive 10 years down the line? Does your board members, are they concerned about the long-term viability and sustainability of your organization? Or are they only bothered about quarter-on-quarter returns? It's as simple. If you need to survive for the next 10 years, you don't have a choice.
Yeah, right. Thank you. So in fact, my last job was as the head of sustainability for the Tata Group. And for us, this question wasn't asked because we survived 150 years by being a responsible business. So for us, it was self-evident, but I still had to make the case in my consulting days. And I think it was pretty much the same arguments. But I think what I found very interesting is, how people see costs and investments differently. And it's the same thing, if you look at it in the short term, is a cost. and if you look at it in the long term, is an investment. And,
Absolutely.
and I think it's just about, so that used to be my phrase, you know, are you looking at the short term, or the point that you made, or are you looking at the long term? If you're looking at the long term, everything that is a cost, the question that the board asked you, why am I incurring these costs? It's not a cost, it's an investment, right? So that's what makes all this work. And if it's true for companies, it's true for the financial sector as well. So thank you, all three of you. It's been a wonderful conversation with all of you. Some fantastic insights, which I wouldn't even dare summarize. There was so much of richness, but I'm sure a lot of that has been recorded. And Shreya, I hope there is some sort of a proceedings that would come out of it, which you can share with all of us in terms of what were the amazing insights that came out. So thanks all of you very much. Look forward to a face-to-face chat sooner than later this year. Until then, stay safe and stay healthy. Bye. Thank you.
Thanks, Shankar. Thank you,
Thank you, Shankar. Yeah.
Shreya, over to you.
Sure. Thanks, Shankar, for this excellent moderation, and thank you to the panelists for this very, very engaging discussion. I'm already seeing that people are congratulating us, Royston, Arindam, and Way on the work that you all are doing. So many thanks for that, and thank you again for accommodating our request to be part of the panel. And thanks again, Shankar. Just for the participants, the next session is immediately at 5:30, so please stay in the body. Thank you so much. Thanks, everyone. Have a good day.
Thank you, Shreya.
Thanks, Shreya.
Thank you.
Thanks, Shreya.
शुरू से मेरे को डाउट था कि बाहर कैसे निकल पाएगी, जो साइकिल ही नहीं चला पाती वो बाहर ये रिक्शा कैसे चलाएगी।
फिर मैं तो ना, मैंने कहा कि नहीं अब तो मैं करूँगी, मेरे को अच्छा लगा ये काम, तो मैं ना हर जगह से, दूसरे देशों से हम लोग आते हैं हमारे यहाँ देखने, तो हमको जयपुर की चीज़ें दिखाते हैं उनको, और उनसे बात करना अच्छा लगता है, उन्हें अच्छा लगता है। और एक महिला रिक्शा चला रही है, हमसे टूरिस्ट खुश होके जाते हैं। चाबी लगाओ इसमें, चाबी लगाओ इसमें, ताला खोलो। खाली पड़ा है ना रोड, तो थोड़ा रेस खोल के, और फिर अपन को सीधे हाथ पे रहता है, इंडिकेटर देना है। इससे मौका, मैं तो खुद ड्राइवर बनी हुई हूँ, पर मैं दूसरी महिलाओं को भी इसमें ट्रेनर बन के उनको सिखाती हूँ रिक्शा। और आमदनी तो मेरी बढ़ी है इसमें, और मैं इसमें ना शेयर भी खरीदा है, जो मैं इस कंपनी की हिस्सेदार बनी हूँ। मैं इसमें मेरी आमदनी बढ़ी है, जो मेरे घर में, मतलब मेरे घर में पहले कम थी, अब ज़्यादा आमदनी होती है, क्योंकि मैं भी कमाती हूँ।
कि लेडीज अच्छे से अच्छा कमाए, अपन यही चाहते हैं, अपनी लेडीज आगे बढ़े,
पति का साथ हो, बच्चों को अपन कुछ भी दे सकते हैं ऐसे। बदलाव है में आत्मनिर्भरता, मतलब आत्मविश्वास पैदा हुआ मेरे में। पहले कुछ नहीं जानती थी, यहाँ तक कि मैं अपने पिछले वाली गली के लोगों को भी नहीं जानती थी।
होटलों के बारे में भी, मार्केट के बारे में भी ये बदलाव देखेंगे बाद में, और बोलने का, चालने का, ये सब चेंज हो गया है।
कैसा लगा? अच्छा लगा ना?
हाँ, बहुत अच्छा है।